Hey everyone, welcome back to another Me Kevin report. Let's get started with this report here on Tesla about maybe losing $7,500 as a tax credit. Let's talk. Oh, wrong one. That's for the next story. Here we go.
Mervyn Block, and that was I had to figure out how to write broadcast news when I left the brokerage business to do this.
Yeah.
Broadcast news.
Well, they were just talking about it. All right, well, I'll cover it. No problem. Okay, so Electric is right now reporting that Tesla might lose its $7,500 vehicle tax credit for its Model 3, and that's because not enough of its battery is apparently manufactured in North America via free trade. That article is actually right here. This is straight from Electric. And they argue here that basically Tesla has told its employees that it expects to lose the full $7,500 tax credit on the Model 3 because the batteries come from China. Since January, some electric makers have been enjoying a surge in demand thanks to a new federal tax credit program. This, by the way, will end March 31st unless you're in compliance with sort of these requirements that a certain percentage of the batteries are manufactured in North America. That could be Mexico, that could be Canada, it could be America. By the way, I have a belief in terms of why this is going on, along with some other commentary on Elon Musk. He's been a little active the last couple of days on Twitter as well. But my belief regarding what's going on here is it's awfully convenient that this is happening the last week of the quarter. Now, I'm not trying to put on tinfoil hat here, but I'm also trying to think as I would if I were over at Tesla. And the reality is, I would love to argue that, hey, look, it's not us, but you've only got 7 days left to check out on that coupon code or something like that, right? That's basically what Tesla is able to achieve here. Hey, you got 7 days left if you want that $7,500 credit. Buy now, get off your butt and buy now, or sorry, you lose the tax credit. So on one hand, it helps push demand for Tesla Model 3s and possibly also other electric vehicles. But the problem is there aren't that many other electric vehicles that are available to buy. I'll give you a little anecdote here. So my one of my family members is super anti-Tesla. They refuse to buy a Tesla ever. They just don't want a Tesla. And so they're super anti-Tesla. And they've told me, hey, you know what? They're in the market for an electric vehicle, but ideally a hybrid is what they're looking for. And they're saying they pretty much can't find one. They were giving me numbers like how there are somewhere around 69 or 70, I think it was 68 Toyota dealerships in California. And over the next year, they're expected to get 180 electric vehicle or hybrid RAV4s. And I'm like, that's 2 per in the next batch for the next 6 months to a year. Who knows if that's accurate? What they're being told? Maybe that's just a way to sort of sell these hybrids. But it seems like there is a substantial amount of more demand for electric vehicles, and yet companies can't produce enough of them. So, with the exception of Tesla, which makes this article especially important because I think really what it's doing is it's trying to yell at the Biden administration and say, hey, your guys' requirements are too tough too soon. We don't have enough capacity yet across the United States to actually be able to fulfill the demand that people want. So, in other words, what would be a brilliant 4D chess move here is quote unquote leak that, oh no, get ready to tell people you're not getting the $7,500 credit anymore, which is the perfect reason to text message all the people who have been interested in Teslas and ask them, hey, are you interested in a Tesla? Because, hey, that tax credit goes away at the end of the month. See, look, it's in the press. Here's the coverage. So it's a fantastic way to get some extra sales, for the end of the quarter. But it's also a way to pressure the United States. It pressures the government in potentially saying, hey, you really ought to loosen the rules on these requirements because you didn't release guidance for this tax credit coming into effect until basically like February. And so thank you for waiving some of the requirements for the first quarter. But now people are going to be pissed and they're going to buy less electric vehicles. And after all, isn't your goal climate change and making sure we can minimize the impacts of climate change? And so if that is your goal, then get off your butt and loosen these tax credits for a little bit of time. It's also really convenient that at the same time as this is happening with these tax credits, Elon Musk happens to reply to Joe Biden bragging about green energy. So Joe Biden, here's the tweet, actually. I'll just show it to you. There we go. Joe Biden writes, in my first year in office, we protected more lands and waters than any president since JFK. We've also made the largest investments to fight climate change ever. Today, we're building on that momentum by protecting additional natural wonders. Well, what does Elon reply to this? Elon replies with, the banks are melting. So he's basically trying to discredit Joe Biden's climate push, as obviously the president can't walk and chew gum at the same time because, well, he's old. That's somewhat of the attack here from Elon Musk. Now, don't get me wrong, big fan of Elon Musk, but it's a great opportunity to poke at the president. But then again, everybody pokes at the president, so that's no surprise. But the reality is, hey, wait a minute. The government can have a green energy policy at the same time as working to resolve a banking crisis. That's why we have a government, so they can do multiple things at a time. Now, do they do those things well? Probably not, but I believe they at least try the best that they can. So as dysfunctional as the government can be. But anyway, at the same time as all of this is happening, I don't know why, but the drama again is circulating about Elon Musk having taken a picture. And I want to talk about Tesla margins as well really quick. But first, I just quickly want to hit it. It's circulating again, this drama that Elon Musk took a photo with basically what's deemed to be one of the potentially largest propagandists, is what she's being called, in Russian media. Here is the photo of her taking a selfie with Elon Musk at the soccer game, the World Cup. And it's really remarkable because it seems as if Elon doesn't even know with whom he's taking a picture. And so a lot of controversy was circulating around why is it possible that one of the top anchors for Russia and potentially Putin's government can just walk up and take a picture with Elon? Shouldn't Elon, with potentially the largest fleet of private satellites on Earth, be a little bit more either careful or protected, or should those around him be screened better? Who knows? Those are just ideas. I think that's really just the media professing their love for Elon. So then we got to hit margins, because there's been a lot of talk about these as well, specifically what's going on with China. So now there was an interesting op-ed yesterday in Bloomberg, and it talked specifically about how Tesla is really setting off this price war, and the price war in China is expected to, at least potentially, lead to a lot of bankruptcies. And so people are a little concerned about that, and because, well, people don't want car companies to go bankrupt. They want more car companies as a choice. But anyway, what are we getting? NIO, the CFO of NIO, told Bloomberg, quote, "We need to go through this price war at the beginning of the year, and then we expect the industry to go through some profound consolidation. It's almost consensus that China now has too many automakers." Now that's interesting, because this is exactly what happened back when the Model T was very popular with Ford back in the early 1900s. You ended up having dozens of different automakers, and basically all of them went bankrupt. In fact, there have only been 2 American car companies not to go bankrupt. Tesla's one of them. So NIO is basically alluding to what happened in the early 1900s as potentially happening again. Now, of course, NIO and XPeng and BYD think they'll be able to withstand some of the additional price cuts coming and the competition coming to the Chinese market. But I find it fascinating that you've got basically Tesla leading the way of these price cuts to where now you have other companies worried, suggesting we think a lot of car companies are going to go bankrupt. It's not ideal for consumer choice, but it is capitalism. That is what happens after all. You tend to get consolidation during rough times, during times of stress. And again, that tends to be a good thing for capitalism because you want the best quality companies to survive, even though that may come at the expense of joblessness for some, although they'll find work somewhere else, or the loss of choice for the consumer. Now, I think the big joy over at Tesla is the ability to maintain these large margins. And these margins that Tesla has, unfortunately, are going to shrink in the case that we do end up seeing that tax credit disappear, which we probably will see that tax credit of $7,500 at least halve to $3,750 again. I think it'll make a great push for end of the quarter sales. So I actually think it's a phenomenal thing in the short term for Tesla. And I think it'll dial up enough pressure on the White House and the IRS and Treasury Department to actually probably revise or loosen their guidance again, mostly because the country wants more electric vehicles to be bought, not less. The point of the Inflation Reduction Act isn't to punish companies, it's to get them in tune and actually start using locally produced batteries. But how do you do that when there aren't enough batteries? In fairness, there just aren't enough yet in America. While at the same time, you have a supply glut of batteries in China. That's something that is freaking out, especially the commodities people. The commodities people are losing it over lithium prices plummeting. Now, look, they're still way above where we were pre-pandemic. But I think it's very interesting because, even the New York Times is talking about these falling prices and potentially the supply glut. So take a look at this here. This was just from a couple days ago here. Lithium, the common ingredient in almost all electric batteries, has become so precious that it's often called white gold. But something surprising has happened recently. The metals price is falling, helping make electric vehicles more affordable. Since January, lithium prices have dropped nearly 20%, according to Benchmark Materials via the New York Times here. Even as sales of electric vehicles have soared, cobalt, another important battery metal, has fallen by more than half. Copper, essential to electric motors and batteries, has slipped 18%. Now, of course, these are down off of highs, but instead what it does is it actually helps sort of rebuild some of the margin that you're seeing at companies. As you can see here, as essentially the commodity prices seem to almost align with the cut in prices of Tesla's 3 and the Y. By the way, it's worth noting the Model Y, which I think is the best vehicle for Tesla that anybody could buy for Tesla. I actually don't own a Model Y. I just say that having owned a Model X and S, I think they're overpriced. And then having been in a Model 3 and Y, I think for a little bit more, why would you not get the size of the Y? That's not to bag on the 3, but it's just to say that marginally, I think there's an advantage to the Y over the others. Now, if you look at the delivery options, which I think is pretty interesting, if you look at the delivery options right now for Teslas, you can see the Model Y is sitting at an April to June delivery. So you have to wait at least 2 weeks for the Model Y, but potentially as long as 2.5 months. For the Model Y Performance, you're at a March to April guideline as much as you are with the Model 3. You're sitting in March to April as well. Looks like they've updated their website as well. New Model 3 and Y vehicles qualify for the electric vehicle tax credit. This is in effect before an update to federal guidance, which Treasury and IRS intend to issue no later than March 31st. So it looks here like this, to me, this is just political pressure being put on by Tesla. And it's brilliant. If I were Tesla, I would be doing the same thing. Don't absolutely. I think they're doing the right thing. It's a brilliant leverage tool to remind people about Tesla's essentially their version of a coupon expiring, For electric vehicles, a major roadblock is cost. Exactly. And this New York Times article, the White House is reading the New York Times. This just helps Tesla as well. Falling price of EVs or lithium is going to help promote EV sales. Price could fall potentially much further. because demand for the metal has not risen as people expected. By the way, I will say that's one of the reasons I personally don't invest in commodities, is commodities are very heavily based on speculation of what could happen. That's my opinion, okay? I'm not trying to offend the commodity buffs. I think commodities are extremely important. I just think the price of commodities is usually so highly speculated on that it's very difficult to actually get a commodity at a sort of a value price or a fair price, so to speak. Mostly because you tend to buy into these run-up hype cycles of commodities, and then they crash when as demand starts waning and people get fearful. Anyway, some analysts suggest this was caused by slowing growth of the electric vehicles in Europe and China after subsidies expired. But other industry experts say the drop suggested that new mines and processing plants were solving lithium problems sooner than many analysts had thought possible. That's another thing. When commodities are very expensive, what happens? You have to think from a capitalistic point of view. What happens when a commodity gets really expensive? Guess what? We end up inventing a new technology to end up extracting and refining that material faster and better and at higher quantities than we had ever thought possible before. I mean, I remember being a child and thinking, well, I still am, but I remember thinking about, oh no, we're going to run out of oil by the time I'm 55, because I remember being a little 5 and 6 year old. Oh no, no more oil, or it probably sounded more like, kind more oil. But anyway, I remember that being a fear as I was growing up, even in first and second grade, being 7 and 8. Oh no, we're going to run out of oil. And what happened in the 2000s? Oh, wow. Look at all this cool fracking technology we got. Oh, wow. The U.S. is actually turning into a major oil producer in the 2010s. Oh, wow. The ability of us fracking doubled between 2008 and 2019, and our output doubled. Wow, look at that. The same thing just happens over and over again with commodities. And you don't have to actually really be an investor in commodities to see that happen. You just have to be a student of history. But anyway, even after falling so much, lithium prices remain so high that mining and processing the metal is usually unprofitable. The metal, uniquely suited for batteries because of its ability to store energy, costs $5,000 to $8,000 per ton to produce. It sells for 10 times that amount. So this is where Elon Musk has regularly come on and said, come on to interviews or earnings calls and said, hey, if you want to print money, get into lithium. Given those fat margins, investors and banks are eager to invest in or lend against mining or processing facilities. You can't have profit margins that are 10x what it costs to extract. This is true. It's going to compress at some point because more people are going to enter the industry. Completely agree. But others, including members of the Biden admin, are less confident. The supply of lithium has to increase 42-fold by 2050 to support a transition to clean energy. We have to find additional sources of supply. But what's interesting is there's this argument that there's not enough, yet, Elon regularly says there's plenty of lithium. It's everywhere. It's just a matter of extracting it. Oh, how convenient. Look at this. There's plenty of lithium in the world, but it was not considered very valuable until sales of EVs began to take off in the last few years. The mining is not what's driving the cost. It's the availability of processing facilities. So need more of those. Most refiners are in China, and few managers and engineers outside the country know how to build processing plants. So see, now it's a knowledge gap, but I mean, that'll fill. I mean, we've got ChatGPT, how to build a lithium processing facility. Supplies of lithium and other critical materials are a national security issue. Last year, the administration established the Mineral Security Partnership, a group that includes the EU and 12 industrialized nations, to locate mining opportunities and finance them. The Energy Department is doling out $3 billion in grants to create a domestic battery supply chain. In addition to the Inflation Reduction Act, which Biden signed into law last year, provides tax credits for battery production. Fascinating. What do we got over here? We got people what look like digging for cobalt, which is also not so ideal because of child labor concerns in parts of Africa. But anyway, here, American battery technology attributed the recent decline in lithium prices to temporary factors like that's not good. Hold on a sec, if you could still hear me. Turn on office. Idiot. Sorry, I'll be right back. It appears you can still hear me. You just can't see me. Anyway, so what else here? There was a time when people believed electric vehicles would grow very rapidly. Then the reality of how fast they were actually growing caught up. Expects lithium prices to fluctuate. All right, whatever. So these investments could turn out to be money losers if lithium prices fall. Yeah, that's the other thing is so many people end up flocking into these commodity projects that at some point we'll end up with a glut of production. I'm really not concerned about running out of lithium. I really think it's nonsense, and it's all fear-mongering, mostly because of my belief of what happened with oil, but also what you tend to see with other commodities that tend to be very important. There are also other batteries that are, end up being developed. I mean, there are, I want to say, sulfide carbide batteries being produced. Obviously, solid-state batteries could potentially not use lithium. So there are various ways to get around these lithium iron phosphate batteries that are manufactured in China right now, mostly in China, specifically in partnership with CATL. Oh, how convenient. Look at this. That helps supply Tesla's vehicles, but or their manufacturing process. But look at this. China's lithium iron phosphate battery cathode material capacity glut will surface in 23 to 24? Question mark. And you got a little picture here of the CATL batteries. China has been the most aggressive in the world. Oh, it's behind a paywall. What a bummer. But anyway, there's been regular talk about this glut of supply, specifically over at CATL, mostly because EV demand has slowed down in China. And now, fortunately, there's a lot of competition, and Tesla's vehicle registrations, from an insurance point of view, are doing phenomenally. Fantastic growth year over year so far into the first quarter here of 2023. Yeah, let's take a look at this here. Let's see. Lithium and nickel miners are taking on additional costs to produce more refined products. The race to obtain battery material has intensified. Market dynamics have changed. However, heightened competition is coming as prices for the raw materials weaken amid concerns that supply shortages could actually give way to gluts. Lithium has fallen. Obviously, it's still trading higher than where it was pre-pandemic and a lot of the EV rushes. But these lower commodity prices are a fantastic thing. Now, Kathy Wood said on CNBC yesterday, or maybe it was the day before yesterday, that she believes it was the commodity price cuts that are actually what are leading to Tesla's essential price cuts. I don't think that's true just yet. I actually think that Tesla and their margins are likely to get hit before those lithium prices or commodity prices come through. Now, Tesla generally doesn't hedge that much against its commodity prices. However, some of its items are entered into contract. So you could end up, and we're not exactly sure which ones, but some of them, for example, you might just buy regularly, like copper. You might just pay spot for it anytime you need it. And something else like lithium, you might pay contract for. Now, if you do lithium in a contract, you might end up having higher prices for longer. And that can hit Tesla's margins for a little bit. So I do worry that if we hop into the margins for Tesla and projections for Tesla, we could end up seeing their margins suffer for at least the first 1 to 2 quarters of 2023 here. And now, I think that if we look at 2023 and the projections, at least Tesla in their last earnings call gave us a little bit of a heads up that we could approach 20% as a gross margin well before we end up hitting 30% again. That's going to hit some of the numbers for Tesla, and I do believe that the market is not fully pricing that in. So I think there's a chance that could create a little bit of a buying opportunity, but we'll end up seeing. Now, then you've got some articles here also talking about this sort of expansion here of additional planned lithium output or capacity. All of this really contributing to the idea that we're going to see continued gluts of lithium. Now, it's also interesting that it looks like BYD, according to Bloomberg, is, quote, capable of carrying out another round of cuts. It looks like Bloomberg's actually citing a few analysts from Morgan Stanley who wrote on March 9th that the price war that was initiated by Tesla might come on faster and more severely than expected, as we expect a market reshuffle. They suggest that NIO, Xpeng, and Li Auto have strong enough balance sheets to stay self-financed for at least 18 months, but that the price war is coming. Well, okay, so we'll see. But this idea that many of these competing companies will end up going bankrupt, I actually think will lead to a large consolidation in the electric vehicle industry. And you'll end up coming out of this recession much stronger as a company that survives. It's not going to be everybody, right? But let's say, hopefully, knock on wood, someone like Tesla and BYD survives. They'll have killed off a lot of the other competition, or they'll certainly during the recession have slowed a lot of the competition. Like even GM and Ford, they don't even expect to be profitable. Well, certainly Ford. We haven't gotten disclosed financials from GM on this, but we don't expect Ford to be profitable on electric vehicles until 2026. Toyota doesn't expect to introduce fully electric vehicles or a larger line because they've got some already, but in more mass scale and more lines, they don't actually expect to introduce electric vehicles broadly until 2026. It's kind of wild. But anyway, this gives us some insight into Tesla, which is pretty useful. Now, some people will say like, oh, but aren't Li and Xpeng backed by CCP, the CCP like NIO? Well, I mean, if you look at a company like NIO, yeah, there's a local government that owns some of NIO. So, of course, there's this incentive to prop up potentially these local businesses. And it's not to say that China won't prop up those local businesses. But I think this argument that China wants to somehow punish Tesla because it's American is actually quite nonsensical. Because if you read Chinese news, which is mostly propaganda, but then again, a lot of our news is probably propaganda as well. But anyway, if you read into some of the Chinese news, like the South Morning China Post, that's one that I like to read. You actually find so many compliments for Tesla from China. And I think the reason that you do is specifically because China wants to promote the idea that manufacturing in China is a good thing, that you shouldn't go to Taiwan, that you should end up staying in China because we helped the most productive facility for China come into existence, Giga Shanghai. And so, yes, there's a price war, and that is going to extend. But oh, that's an interesting sound. I'm getting a little ad here on the South China Morning Post. But anyway, they argue here, electric cars, one of the few fast-growing sectors, will be less of a growth driver for auto sales in China this year because of shrinking fiscal revenue, making it difficult for the government to extend subsidies on purchases. New EVs will be less supportive of sales growth this year. And there's been no indication that there will be a renewal of cash subsidies. So that's also helped lead to some form of a glut in lithium. But then also you have macro factors. I mean, just the fact that we're walking into a recession. But I think it's very interesting that when you look at China from sort of a propaganda point of view, what would they rather do? Would they rather slam on China or slam on Tesla, or promote Tesla as basically their love child? Their foreign love child. Please come manufacture more with us. That's my take. I mean, it makes logical sense to me, but then again, logic doesn't always enter into the equation of what happens in geopolitics. But I do think that's something strong to consider. See, look at this. Yeah, here I found it. There we go. So look at this. This I think was interesting. China outgoing premier vows even greater business opportunities for foreign investments. Analysts say that attracting more foreign investment, especially from the US and Europe, could help curb decoupling, but restoring positive business sentiment cannot be done overnight. While acknowledging the external demand, that external demand will be relatively weak this year, Beijing is sending strong signals that it intends to better integrate global trade. while vowing China's appeal to foreign investors, vowing to enhance, that is. Leadership has also set its sight on the Comprehensive Progressive Agreement for Trans-Pacific Partnership, a high-end trade and investment pact in line with efforts, blah, 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 blah. National People's Congress reiterated this. Okay, fantastic. Look at this right here. Zhang and this other person have a directive to facilitate the launch of landmark foreign-funded projects. That's the goal of China, right? And right here, it then says, call to mind what happened with Shanghai with the Tesla Gigafactory, which was one of their major achievements, China's major achievements during their term in Shanghai, or the mayor's term over here in Shanghai. Whether more projects like this will be added or launched is something we should look forward to. So I find that very interesting. You know, to me, I think that's a fantastic way of saying, hey, we're in a position where investing in China is actually a good thing, and China wants to keep that investment going. Of course, we're facing a pretty large macro recession, a banking crisis at the same time. You know, you've got some multiple worldwide disasters, but I think it bodes well for Tesla, because if China is trying to prop everyone up and attract more investment, if commodity prices are falling for whatever reason, and it's likely that other automakers are going to go bankrupt, well, that ends up being a boon for Tesla as a survivor. That is, if they survive. Anyway, we can talk about that in the courses on building your wealth, link down below. Changing the pricing after this live stream. All right. Let's move on. Let's listen in over here.
More regulation and concerns about deposit flight. So then what do you do with that?
Let's say DeLongis is going to join us shortly. He came into the year constructive on risk assets. Then he got into the month of March and he became less constructive on risk assets. We'll talk to him about that. Alessio DeLongis of Invesco coming up very shortly. Equities up 0.5%. Yields up too by 6 basis points. Just short of 350 on a US 10-year in America. 349.41. A Bank of England rate decision about 50 minutes away.
Ooh, juicy. Fine then. They all go on commercial at the same time. It's really annoying, but that's all right. Cheers to coffee, folks. We got a lot to talk about. We are going to talk about Coinbase next, because that has a little bit of drama going on with it as well. It seems like there's never a lack of drama, though. You know, Coinbase. Wow, it's down 11% right now. So we'll touch on Coinbase a little bit. Yeah, but can Tesla meet demand if others go out of business? Well, I mean, that's the whole idea, is that they have, I mean, it's so weird. It's like the questions go from, oh, is there enough demand for Tesla, to, oh, but wait, can Tesla actually meet the demand? You know, as long as there's more demand, it's actually fantastic for pricing power. Crude is dropping. You know, oil has been trending down. There's so many people calling for this $100 a barrel revisit, and I've been saying for like 6 months, no way. Oh, how interesting. What do we have here? Oh, look, an article on Ford. How convenient. It just happens to be on the same topic. Yeah, look at this. Here's a piece that was just posted on Ford. Ford's EV business lost $2 billion in 2022, offset by big profits in fleet and legacy units. Ford says Thursday its electric vehicle business lost $2.1 billion in 2022 on an operating basis. Oh, good Lord. That loss was more than offset by a $10 billion operating profit between its ICE and fleet business. Now, that's your regular gas guzzler. And then fleet, of course, would be like its transit line and commercial van lines. So Ford said Thursday its EV business lost $2.1 billion. The Detroit automaker expects 2023 to unfold along similar lines, forecasting a $3 billion loss for its electric vehicle unit, adjusted earnings of about $7 billion for its ICE unit, and adjusted earnings of about $6 billion for its fleet business. The financials are the first look at a unit at unit profitability as Tesla unveils a new financial report, or as Ford unveils a new financial reporting structure aimed to give Wall Street a better understanding of how its EV business is evolving. The reformatted reports follow sweeping reorganization, separating Ford into 5 businesses. Ford Blue, its traditional ICE engine business. Ford E, the electric vehicle business. Ford Pro for commercial and government. Ford Next, which includes non-automotive mobility solutions and other future tech. Okay. And Ford Credit. My gosh. We've essentially refounded Ford. And this is a joke. I mean, basically what they've done is they've now separated the money loser from the profitable business. And what's going to happen is they'll probably just keep milking the profitable businesses until those go bankrupt. And then the hope is that they could be profitable on electric vehicles before they go bankrupt on their legacy business. Because if they go BK on the legacy business, because everybody goes to EVs, they're going to have a little oopsie doopsie problem trying to transition. So the goal is, how can you become profitable on EVs before you go bankrupt on gas vehicles? And hopefully there's not too big of a gap, because if you go bankrupt first and you're still not profitable on EVs, or you haven't gotten them to scale, then you're going to go bankrupt here too. So I don't know. It's going to be very interesting. Somebody here writes, I just bought a 2020 Ford Fusion rather than an EV. So you bought a used car, which is probably the financially right thing to do. I actually think that for most people, it makes sense to just not buy an electric vehicle right now, because I think, first of all, I don't even think you should be thinking about buying a new car right now. I think we're in such a recessionary environment. The last thing you should be thinking about doing is spending money on a car. You should be doubling down on how much money you can make, and then investing or building businesses or doing everything you can to build your wealth. I think now's the time to do that. I wouldn't spend a dime on a new car right now. I think it's a bad idea. So I would triple down on how much dollar hollers you got. But look, today electric vehicles are very expensive. I mean, if you were going to get a car, I would get a car that can get you from point A to point B with reasonable safety and comfort, and go from there. And maybe that's a Ford Fusion, maybe it's a Toyota Camry, maybe it's a Honda Civic. Would I really be jumping up and down about spending money on a hybrid or something? Really, what you're doing is you're just prepaying in gas, right? That's what it is. You're prepaying in gas. Like you buy a Prius for 30 grand, or a 2020 Ford Fusion, you buy a Prius for, let's say, 30 grand, or a 2020 Ford Fusion, assuming both of them, let's say, are used. You're basically prepaying $10,000 of gas, because the cars are virtually the same. Yeah, look at this. You could get a Ford Fusion for $20,600 right now. Here's another one. Certified 2020 Ford Fusion, $19,800. I mean, that's a lot more, financially responsible than buying an EV. Don't get me wrong about that. But then again, most people aren't financially responsible, and that's okay. It helps. Lets the economy keep going around. Somebody here says, I got a 2015 Baracco 175cc. I don't know what that is, but that sounds good. 1.7 liter engine. Wow. Found off-road dead. Let's see here. Somebody says, I no longer own NVIDIA, Apple, Google, Facebook, or Amazon. I just invest in QQQ. Well, if you just invest in QQQ, why don't you invest in QQQM? Like, you'll save fees. Have you not heard of QQQM? You should research that. It's the same thing. Except rather than paying the fees that you pay at QQQ, you get the same thing for less fees. Wait a minute. Why didn't they just drop the price to QQQ? Why would they? Everybody knows about QQQ. Just milk the extra money. Put it in QQQM. You get tricked. All right. Keep listening on over here for a moment. What do they got?
Ideas circulating on TikTok. So there's going to be a range of issues at play here. And really, he's going to have no allies in the room. This is a lose-lose hearing for this CEO. What he has been doing is try to fight some of this before he goes into that room and gets grilled by lawmakers. He came out with his own TikTok and said, if you want to make sure you can keep this app for all your content, there's 1.5 million Americans that are on it. put your appeals in the comments and also call your elected officials. And what you're seeing in Congress over the past 24 hours is actually the youth in the rotundas creating TikTok videos. They're there in support of the CEO.
How do you prepare, John, for a lose-lose hearing? If you know you're heading into the firing squad where everyone's just going to hate you, how do you prepare for that?
Look, if it's about security and national security, that's it. Bottom line, it's over. It should be conversation over. It shouldn't be about pleasing a certain part of the electorate because they use an app that you might ban.
Well, and this raises a question, and Anne-Marie, weigh in on this. Why haven't they banned this if CFIUS even recommended either a sale or some sort of ban?
Okay, so this has been through CFIUS prior to the Biden administration as well. During the Trump administration, Trump had an executive order that wanted to outright ban the app, but it got struck down in the courts. There's been a slew of legal challenges on that executive order. Then the Biden administration comes in, they had to redo that executive order, set up CFIUS again. That is why you have this issue we have today. It really got hobbled up in the court structure. Congress is the one that needs to move and give the authority to the executive branch to make a move on TikTok. Right now, I know you guys will be speaking to Senator Mark Warner in the next hour. It's his bill in the Senate that has the White House backing. That will give the Commerce Department to look into items like TikTok, not just TikTok. They want to give it broad support. What is interesting about this will obviously take months. They need to make sure the House gets on board as well to then send it to the president. And then once it goes to Commerce, then Commerce needs to do their review. This is going to come very close to the 2024 presidential election when Democrats certainly need those young eyeballs on TikTok. That's where they get their news. And these individuals lean liberal and likely would be voting for a Democratic president.
That's where I was going to go, Anne-Marie. I've been making
that is very scary that young people get their news from TikTok. The problem, and I also, to some extent, feel a little concerned about Twitter, although less so than TikTok. It's just when you get short context information, it's very difficult to actually think critically about the information that's presented. Usually, the stuff that does well on TikTok is very, very out of context, short term, and dare I say, like, designed to be viral. And that's fine. Like, that's the goal. But I think the level of quality there is not something we should be very excited about. I also think it's very interesting that TikTok is taking out an insane amount of ads. Watch this. So check this out. I have this TikTok that I put together here. And I want you to watch it for a second because it really relates to what's going on with the TikTok CEO being in Congress to defend this idea that, oh, we protect your user data. Keep in mind, almost every single time that I open up my phone, TikTok's begging me to look at my contacts. And I don't know how many times I need to tell it no, but it just is begging me to get my contacts. And it's really, really annoying. And one of the big concerns is TikTok says, oh, well, we only store U.S. data in the United States. Yeah. Well, why did the New York Times then find U.S. TikTok data on a server in Singapore controlled by China? So these are just the concerns that people don't really trust TikTok. And that's a little bit of a problem. Now, I want to play this for you because it gives you a little bit of an idea of what TikTok is doing. Now, part of the reason they're doing what I'm about to show you is because they don't want to lose advertisers. So they're trying to send this signal that, don't worry, we are doing everything we can. We will make sure you're safe, because there are a lot of advertisers that think, oh, we might end up losing our ability to advertise to Americans on TikTok. And that's not good. We don't want to lose our ability to advertise to Americans on TikTok. We like Americans on TikTok. This is despite the fact that people have been, and this has been studied, people have been found to be relatively passive on TikTok, to where you don't actually get the kind of ad revenue that you get on YouTube Shorts or on TikTok because of the mood people are in when they're using short form content. And I found this myself as well. So I'll use myself as an example here. But I really try to avoid doing this because I find the value that I get out of TikTok is probably maybe 1 to 2 minutes of value out of an hour of scrolling. But what happens is you get into this mindset of just scrolling. And from an advertising point of view, you actually become a very passive person. Whereas when you're listening to, let's say, a YouTube video, you're not sitting there usually actively scrolling. You're usually doing something else. Like maybe you're typing emails, you're getting ready for your day, you're getting dressed, you're driving somewhere or whatever. But because you're also capable of doing something else without constantly having to change the video every 30 seconds, you're also capable of getting yourself life insurance in as little as 5 minutes by going to metkevin.com/life, or getting 12 free stocks with Webull by going to metkevin.com/free, interacting with a paid sponsorship. That is different than what you get on TikTok. So advertisers are already worried about the revenue that they can pull off of TikTok. And now they're worried, are we just going to totally lose that partnership? Because one thing that you can do well on TikTok is brand advertising. This is really talking up a brand rather than expecting some form of direct response, like somebody going to a link like metkevin.com/life or metkevin.com/free or the programs like that, or whatever, right? All right, let's listen to this TikTok here, because the one that I made, because I think it's enlightening about what's going on. Watch this. TikTok just did. So there's been a lot of talk about banning TikTok. There have even been bills introduced to ban TikTok because people are worried that TikTok is farming our location and contact data and selling it to the Chinese Communist Party, where TikTok's parent company ByteDance is based. This right here is today's print edition of the New York Times. It is the paper version of the newspaper. They make money selling ads. And it's pretty typical to see full page ads. Like this is a full page ad right here. It's very expensive. But what's not pretty typical to see is when we go to the middle, a full page ad from TikTok solely talking about privacy. But it's not just a full page ad from TikTok in the primary A section of the paper. It's actually a whole centerfold about taking our data concerns seriously. A whole 4-page section on this. Methinks thou protest too much. Oh, I can't believe what TikTok just did. Yeah, so it's basically this argument of, hey, like, wow, that's a lot of effort y'all putting out there, TikTok, which is fine, but that's a lot of an ad in the New York Times. That's just the New York Times. Now, another thing to consider is that the monetization value from a data point of view for TikTok is deemed to be about 1/3 that of Facebook and just 1/5 of that of Instagram. The TikTok CEO is testifying before Congress today about, he's going to have to answer questions about, hey, basically, like, why should we not ban you, right? TikTok has about 150 million users in America, and TikTok changed really the way social media and video really worked. I mean, they were transformative in this idea of people using short form content. And I find it very interesting to look at the forecasts and projections and the growth rates of people using TikTok versus people using, say, Snapchat or Facebook. The Economist put together a fantastic piece on this data. I really enjoyed it. The chart basically shows, when I show it to you, this decline of a Facebook viewership, while at the same time we see a rise in viewership on TikTok. The problem is that, or maybe for TikTok, if there is any problem, even that growth is slowing down a little bit. Take a look here at the chart. So here you've got a time spent per day in minutes. And then this is the 18 to 24-year-old age group. And you could see TikTok over here had a lot more of an explosion in 2019. But then you had an inflection point here where that slope slowed. Again, in 21, the slope slowed. Again, in 22, the slope slowed. And again, it's expecting to slow in 2023. So there's really a limit. You're approaching some form of a limit to how much people are going to be able to want to watch Facebook. But at the same time as that limit is being approached, Instagram and Snapchat are sitting roughly flat, and Facebook is in decline. Now, that's not too terribly much of a surprise. You could see that actually thrown out a little bit more clearly even in this age group here, 25 to 34. You could see TikTok, the orange line, is growing very nicely. Instagram somewhat slowly. Snapchat flat and Facebook down. These charts, thank you to the Economist for them. But TikTok basically directly takes time away from people using these other platforms. The problem is they don't create as much advertising value. The advertising spend per hour for Instagram is expected to go up to and approach about $2 of advertising spending per hour of content watched, whereas TikTok is not really expected to exceed about 40 cents per The Economist. Now, it's also worth noting that TikTok expects to make about $67 off of every single American user this year. Instagram is expected to make about $200. So if you use both TikTok and Instagram, you're worth $67 and $200 respectively. Currently, the monetization is expected to improve for all these products as well. Although then again, for YouTube, we were told that YouTube Shorts would be somehow game-changingly profitable for YouTube content creators, and the amount of money that YouTube Shorts create is a joke. I mean, there was this idea that, oh, maybe if YouTube Shorts actually generate good revenue, people would be motivated to make better short form content, like better quality stuff. But the reality is, no, there's like no money in shorts. It's almost a waste of time. But anyway, there's let's see here. The Economist makes the argument that maybe ad revenue will improve because right now these platforms are still relatively quote unquote immature. They suggest a reference to Facebook, where Instagram stories took a while for advertisers to sign up, but now it's a big money earner, stories. Although in stories, it seems like people are a little bit more active in actually responding. Unfortunately, though, the ads that you get on a short form video are almost always going to be less valuable than that on a, say, 5 to 8 to 10 minute YouTube video. It looks like about 40% of all Meta's advertisers, about 10 million different brands, it's wild, use Instagram Reels for ads now. It's pretty impressive. So there's a suggestion that maybe there could be a coming shift over to some more advertising for these shorts. However, more than 24 governments have now placed have basically now banned TikTok on government phones and government devices. And the reason for that is there's an argument perhaps that TikTok can be watching and recording you while you're basically performing other tasks on your phone. Whether that's logging into your bank account or going and browsing through other websites. Apparently, there's this potential risk that tracking pixels are following you around to all of these other websites when you're using your phone. Now, some say that this is exactly the reason why TikTok needs to be banned. Of course, I think you can regulate this. But this could also just be sort of like a China versus America, like we're angry disaster. But really, I think given the drama that we're about to see unfold in Congress with TikTok, I think the idea is that TikTok's probably not going to go away. It's probably going to remain, even if it ended up getting worst case spun off into sort of a quote unquote US owned entity with data more strictly controlled in the United States. I don't see TikTok fully going away, even though some governments are starting to ban their employees and officials from actually having TikTok on their phones, and that's fine. But this space is still relatively new. It's interesting though because it's just the amount of content that gets produced on TikTok that doesn't generate a lot of revenue is actually surprising. At some point, the hope is because people are so captive on TikTok that maybe it will end up driving a lot of revenue in the future. We'll see. But that gives you a little bit of an update on some of the madness that's going on with TikTok. Some speculation about whether maybe Microsoft or Oracle will end up snagging TikTok and basically taking control of TikTok US from ByteDance. We'll see. For now, I don't know how big of a deal it is. I mean, I have TikTok. Hey, maybe, you know what? Maybe the trick is everybody just needs to have 2 different phones. One that you could use TikTok on and one that you use for everything else. That's it. Every household needs a TikTok phone. Yeah, how about that? That's the phone you're allowed to use if you want to go on TikTok. This, by the way, is the Wall Street Journal's review of U.S. state government websites use TikTok trackers. Review finds more than 24 governments have placed web tracking code made by TikTok on their official websites. So this is a little different from spying on your phone. Some say that TikTok can actually like turn on the camera to your phone without you knowing to get what your reaction is to certain content to determine whether or not to feed you more of that content. When we're talking about tracking pixels, we're usually talking about a section of code that you can take from TikTok, like as an advertiser, and purposefully embed into websites that you control. And then there are little plugins that you could run to see, hey, which websites are actually using that tracking pixel. And it's actually pretty useful for the purposes of retargeting ads. And I suppose it's possible that if, let's say, the IRS wanted to run ads about, make sure you don't cheat on your taxes on TikTok, they'd probably want to put a tracking pixel in because they'd probably hire an advertising firm that would implement that tracking pixel. But anyway, a review of more than 3,500 websites, organizations, and government entities by a Toronto-based company, Affirut Security, found the so-called tracking pixels from TikTok were present in 30 government websites across 27 states, including some states where the app had been banned. Presence of the code means the U.S. governments around the country are inadvertently participating in the data collection efforts of a foreign-owned company. I think this foreign-owned company thing sometimes is a little bit fear-mongery. I don't know how really terrible it is. It's like, oh no, China has some of my data. I think that sounds a lot more scary than it is. And there is a privacy element. I do think it's worth being able to consent and control that data. I think that's very important, right? If I want to be able to share stuff with my contacts on TikTok, I should be able to opt in or opt out. I do think it's annoying that basically every time I open the app, I have to deny access to my contacts because they want it so badly. That just makes me a little bit more concerned. Like, what are you going to do with it? But anyway, TikTok has previously emphasized its user data is stored in the US, not China. Right. But we've also seen that data in Singapore controlled by the Chinese Communist Party. So the data has certainly made its way out of the US. Now, with some of the arguments here that, oh, well, those were just backups. Oh, okay. All right. Anyway, so this Wall Street Journal piece goes into a little bit of this tracking code here. And then, of course, the TikTok CEO will be testifying in Congress today against the banning of TikTok in America. China and Russia routinely deploy shell companies and proxies to extract marketing and consumer information from advertising exchanges that display ads, according to people familiar with the matter. In many such cases, data can be used to obtain precise geolocations of devices based on location information in the apps. See, that's also a little weird if they could sort of track your information, like your location around. I think that's where privacy concerns elevate even more. Or you start getting access to potentially banking information or financial information. The tracking data information, I think, has always been very fascinating. Think about this. The U.S. government might not be able to track your phone per se, like may not technically be able to go into a computer and say, give me the location of Kevin's phone, and now I'm going to track it. But they would be able to zoom in essentially on a heat map to my home and find, oh, look, there are 2 or 3 phones in that house because there are 3, geolocations we're getting. Let's just track those 3. And Kevin's probably one of those, and so it's kind of scary how your data and your location can be tracked very well. And I think the biggest concern about privacy when it comes to things like this is we just don't know yet, right? We just don't know yet what the data is being used for. For example, somebody here writes, Dreamer Springwalks writes, it's a foreign country using your data, not in your best interest. Yeah, you're probably right. And I think that's the thing is we have almost this potentially dangerous apathy towards, well, like, what does it matter if it has some of my data? Let's see. I agree. I hate that it tries to get me to text message people my videos. Yeah, I mean, they do want to make it viral to spread the stuff, but you're right. In order to do that, they want your contacts and those numbers. Come on now. Like, people even know about a code. And if they did, 95% of them still wouldn't use it. I think you mean regarding the tracking pixel. Well, that's advertising companies using that. Yeah, it's to contain metadata. Exactly. Looking at some of your content here. The in-app editor is nicer. Yes. Yes. That the TikTok in-app editor is pretty good. You aren't really missing anything if you don't have TikTok. I mean, I hate to say it, but I agree with that. I really agree with that. I think providing value on YouTube is so much more of a conversation and deep-based perspective, whereas usually on shorter form media content, you just get snippets of information. Like I'm going to show something here, and this is not to be political, but I know it's going to probably piss some people off, but I think 95% of you are going to look at this and go, I mean, that's a reasonable, explanation potentially of where we might want to be a little bit more jaded, right? So y'all have heard about the Trump indictment, right? And I'm going to keep this one very, very brief. Well, the idea is that basically Donald Trump paid money to Michael Cohen, who set up various different entities, and then paid Stormy Daniels off for hush money. And again, this video is not designed to be about Trump, so I'm going to keep it very, very short. But what I think about short form content on sort of the topic of TikTok, what I think about short form content is you get snippets like this. So here's this guy who pretty much only covers stuff that's super pro-right. I haven't seen something pro-left ever. But anyway, so this guy, Benny Johnson, new bombshell document destroys Manhattan's district attorney case against Trump. 2018 letter from Michael Cohen's lawyer to the Federal Elections Commission declares Cohen used his own personal funds to pay Stormy Daniels. Trump camp, not party to transaction, did not reduce or reimburse Cohen for payment. It's over. And makes this argument that basically this is over. Like there's no case against Donald Trump anymore. But like I hate to be jaded. And I'm not here. This is a video. This is a segment about TikTok, okay? And in this segment about TikTok, I just want to talk about like logic and perspective, not about left or right, okay? So not about politics, just about logic. So from a logic point of view, looking at this from a logic point of view, first of all, the source of this letter allegedly is the lawyer for Michael Cohen. So Michael Cohen is who has already been punished for this, is the source of this document, and so there's this potential that what if Michael Cohen was always set up to be potentially the fall guy for this, and they knew they would be the fall guy for this, which is why we ended up with the conviction against Michael Cohen. Is it not possible that, yes, hush money could have been paid by Donald Trump or somehow to Stormy Daniels, and this letter is maybe potentially slightly untruthful? We don't exactly know. We know there's a segment in here that says neither the Trump organization nor the Trump campaign was a party to the transaction where Cohen was potentially reimbursed directly or indirectly. That's fine. But what about Donald Trump personally? You see what I mean? Like there can be holes here. See, neither the Trump organization nor the Trump campaign was a party to the transaction. Okay, well, was Donald Trump's trust? Maybe Donald Trump's family trust was a party to the organization of reimbursing Michael Cohen, right? And so my point is, and then like, dude, come on, any person can write highly confidential on their document to make it seem more official, right? I could do that. I could send you an email back and go, hey, here's a bundle coupon and put highly confidential on it. Like anybody can put highly confidential on it, okay? So my point is, I think short form content, while it's really fun to go to sleep with, I think often, and it frustrates me about Twitter, frustrates me about TikTok or Shorts, is you tend to lack that sort of nuance and even just asking the question, raising the question, right? So I think it's very interesting to just actually think about that sort of perspective. So that is my take on the TikTok drama, which of which there's a lot. All right, let's see what CNBC has in store for us this morning. Often they have good interviews in the morning, but I'm not right now. I get TV commercials every time. So yeah, I guess there's another thing to mention. Let's see here. Oh yeah, quite a few other things. So credit thief, the replies. Oh yeah. Oh, okay. So the other thing also, just to kind of show you what just another thing about sort of just on the note briefly of that short form content is that same person wrote a message on TikTok, the same person, and suggested that in 2018, Stormy Daniels said she never had an affair with Trump. In fact, she said it was all made up to get the money. Stormy lost her lawsuit against Trump and was ordered to pay him $300K for legal fees. So what's interesting here is that she has obviously argued that, well, she made that statement under duress. But this, of course, this person doesn't mention her argument that that was made under duress, which is fine. Maybe she's either lying then or she's lying now, right? Like somewhere there's a lie. It was either then or now. We know that. Something's fishy here. But we also know that when you say that she made it up and lost her lawsuit, it implies that a judge actually ruled she was a liar. But that's not actually what the judge ruled. So I replied and I said the lawsuit was about defamation regarding Trump's tweets about her, which were rightfully protected by the First Amendment, which was why she lost the lawsuit. The lawsuit was not about whether or not the affair occurred. Of course, somebody replies, because she admitted there was no affair. Well, again, she's admitted to both directions. And I'm not trying to take sides, just trying to say the short form content never gives you the depth of information that I think is actually required to have a full understanding of reality. But who knows? I'll be dying on that hill probably of trying to get depth of information. So that's all right. All right, come on. So many ads on mainstream TV. It's kind of remarkable. I feel like you have less actual content than you have ads.
Guaranteed and insured wasn't even part of a discussion, a conversation.
He can't win, really, can he?
No,
he
he
came
can't.
out and he did a great job by all accounts to basically be as dry as possible and not say anything new and not go off script. And then Janet Yellen goes, yeah, about that whole deposit thing, whatever you thought, it's not really the
He
truth.
was never going to win.
Yeah.
We said it going into it.
He wasn't going to win.
Like there was no winning. There's no good decision. After yesterday, after the last few weeks, I'm sure Danny shares that view. Danny Blanchflower joins us now, the Dartmouth professor and former member of the Bank of England Monetary Policy Committee. Danny, the Bank of England, inflation year over year, double digits, people looking for a rate hike. Do you think that's the wrong move today?
Well, I do, as you might imagine.
Well, I guess.
There was some news yesterday, which was inflation rose more than folks think, but that's gone, that's past. We're supposed to be focusing on what's coming. There's a major credit crunch, and the reality is that the Bank of England, in its forecasts, is forecasting no growth whatsoever for 3 years, inflation below the target, and we've just had a huge fiscal tightening. So basically, guys, assume they're going to raise. Everyone thinks they will, and what we're going to sit and watch here is disaster coming. Feels like 2008 all over again. Who's holding what bad stuff? Presumably in the UK, with the mortgage markets now in disarray, we're going to start to see banks holding bad mortgages, like that people can't afford to pay. So I think this is the peak. This is a huge mistake. I would have been voting for big rate cuts. And what you'll see in the United States and the UK is disastrous data will show, and central banks will then move into panic mode, as the markets are pricing in already.
Danny, 25 is the wrong move. So let's talk about the Federal Reserve. Was that the wrong move yesterday?
Well, I think so too. I mean, we're seeing inflation now clearly has peaked. I mean, the question is, to what extent is this credit crunch a big deal? I mean, our pal Torsten Slot thinks that it's the equivalent of about 150 basis points of tightening. That's probably true. So this is a new set of tightening over where we were. The Fed has actually been entirely guessing. There is no economics to base their claims that this would be a soft landing. So you keep going and you keep going, but outcomes come about 18 months later. So the question is, what is there out there that we don't know? And you reported so well on Credit Suisse and the $9 billion that UBS had to receive to kind of make up for what's hidden under the hood that we didn't know. So at these times, you should be cautious as to what's coming on the downside. It's hard. I think the only question is, how bad is it going to be? So this looks like a wing and a prayer. We're going to carry on raising rates. Well, let's wait for some data to come. And my assumption is that it will start to come. I mean, the markets think it's going to come. I mean, Powell says, maybe we'll raise rates, but look at the Fed Watch tool. CNBC's Fed Watch tool says markets are pricing in 3 cuts by the end of the year. So why would you raise when the markets think you're going to cut? So we're in confusion. We're absolutely in confusion. And it really feels like 2008. In the UK, we rescued Northern Rock, thought that would solve everything. What happened was Bradford and Bingley, Alliance and Leicester failed, RBS failed, all about 6 to 9 months later. So watch this space. This was an error. Shouldn't have done it. There is no economic basis for anything that they're doing. And the real economy is what's going to matter. And wage growth is a big deal. That's not picked up in the way that they thought.
Well,
but really, the real economy is
Danny,
what we're going to.
I have to cut in here because a lot of people are listening to what you're saying and saying, really, like 2008, banks aren't as leveraged at all. What you're dealing with is a liquidity crunch, not a credit crunch, at least not yet. And you're talking about assets that are backed by sound loans, not necessarily mortgage debt that was taken out by somebody with no income and who put nothing down. So this is a very different kind of scenario than it was in 2008. How do you push back against that and say that this is comparable?
Every credit crisis and every housing boom, for example, the standard thing that everybody says is this time's different for a variety of reasons. Yeah. This time is different. It simply can't happen again. I mean, it's not just about that, Lisa. I think it's about confidence, remember. It's about confidence that the banks are whole. It's about confidence that my deposits are safe. And Janet Yellen, I think, made a huge error yesterday. I mean, her error was actually answering the question. So now we think, you have $1 million in some regional bank. What should you do? Well, obviously, you should pull that money out. If it's not guaranteed, then you should pull it out and take it to Bank of America. So that looks like an error, but it's about confidence, Lisa. And each time in the history of crises, everyone says this time is different. And I think the other thing is that, I mean, as you say, you guys have reported on it. What did UBS see under that hood that we don't know about? So I think that's a great deal of it. I mean, remember, as I say, in 2008, who would have thought in August 2008 that RBS would fail 2 months later? I think it's these kinds of surprises.
Let's put the banking.
I could be wrong, of course, but I think you have to be mindful that this is a credit crunch.
But let's put the banking crisis aside for 1 second, the known unknowns, the unknowns, whatever you want to call them, and just take a look at what the data was showing before this particular meeting, this sort of perhaps backward-looking, but hotter than expected inflation data that was persisting in the U.S. as well as in the U.K. and other European nations. From your perspective, have you been surprised by how sticky inflation has been, how long it has taken to show signs of coming down? Does that get you concerned at all about where we're heading in terms of Fed policy being used as a tool for financial?
The way she said, does that get you concerned at all? Sounded like she was asking him, does that get you excited at all?
It's obviously because there are shocks in the UK context. There's shocks imposed by Brexit. But again, go to August 2008. What you said was essentially what people said then in August 2008. Inflation was 5.5%. Within 9 months, it had gone to deflation. And what we're seeing in the United States is those base effects are dropping out. Certainly, if you look at the unseasonally adjusted inflation numbers, they're really very, very low. I mean, a lot of actually what you're seeing is about this weird technical thing about the seasonal adjusting. So really what we're talking about is inflation's high because of the way they've seasonally adjusted using new methods. So I think the answer is that look at the wages. Wages have not picked up in the way that people thought. Wage growth has been relatively benign. I mean, it's hard to read the data, Lisa. I mean, it's as if people think we have a nice playbook. We have never seen anything like this other than the Great Recession. Every piece of data since 1945 to today is utterly irrelevant. We have to look at other crises. And what you'll see is then suddenly inflation plummets. So I think that's what's coming.
Danny, I've got to squeeze this in. Just 60 seconds left. If they came out and offered blanket deposit insurance, would your view change?
Probably would, actually. I mean, I think in a sense, the answer then John, is that wouldn't the Bank of England and the Bank of Canada and the ECB have to do the same? But I do think that the blanket deposit insurance would really be a help. Certainly think that.
Danny, thank you, sir, for catching up with us. Danny Blanchflower.
Okay, that was awesome. Let's break that down because there was a lot of information in that. This guy, like, this is a top G right here. And I don't mean like a top G like somebody who's stuck in jail. I mean like a finance top G, okay? So basically an old white guy. Okay, so what do we have? Well, look at this. So first of all, this is the inflation that Jerome Powell was talking about yesterday. Unfortunately, during the intra-meeting period, coming in a little hotter than expected. And really, this idea is that if you look at averages over the last year, yes, inflation is trending down. That's fantastic. If you look at averages of over the last, say, 6 months, okay, yeah, inflation also, oops, let's go ahead and make the line actually go the way there we go. It's also trending down. That's fantastic. In fact, the way you would probably draw this average is something more like this, since these low points right here would drag the line down, right? So that's probably more of the moving average that you're looking at right now. The problem is this little pickup that we got right here. Why, if we now look at just the last 4 months, are we trending up on basically core CPI on a month-over-month basis, right? And this is what's creating some concern for Jerome Powell. Now, I think this individual makes a very good argument, is that Jerome Powell is so concerned about what these CPI and PCE numbers are showing. PCE is the Fed's preferred method of CPI. It's basically the same thing, a little different with weightings. But they rely so heavily on these seasonal adjustments, and their weightings are based on some weird things. The weightings used to be based on an average of 2 years of data. Now they're based on 1 year of data. Then at the end of every year, we change the weightings. Everything's a complete disaster. Everything completely changes, right? So what's remarkable about that is you have this individual suggesting Jerome Powell's convincing fight against inflation is what's probably going to destroy our economy. Now, that means recession. In fairness, Jerome Powell kind of alluded to us walking into a recession yesterday. In fact, I would go as far as saying Jerome Powell basically yesterday told us the recession's confirmed, folks, buckle up. There are a few reasons for that. Number one, Jerome Powell, when asked about the soft landing, basically said, yeah, there's a path. We're trying to find it, but basically it's not happening. We're going into recession. So Jerome Powell realizes we're going into recession. Beyond that, look at this chart right here. This chart shows Jerome Powell's front end of the yield curve. It is called Jerome Powell's favored recession indicator. And based on this, it has always been correct in the past. We are going into recession. When this sucker inverts, a recession follows within 18 months. And Jerome Powell realizes that. Now, obviously, markets change their opinion of what's going to happen with either rate cuts or rate hikes based on data. For example, there's somebody in the chat here saying, Kevin, you initially thought 2023 rate cuts would happen. Then you said they wouldn't as market priced no cuts. Okay, you have to remember, when I'm reporting whether rate cuts are coming in 23 or not, it's based on what the bond market is telling you. In fact, I provide you the data of what the bond market is showing you and showing you the charts saying, hey, this is what the market's pricing in. Right now, the market is pricing in 100 basis points of rate cuts for 2023. This is the same thing that was true in November of 2022. The problem was in January and February, all of those rate cuts went away because inflation started running up. Then we had a banking crisis, and then the rate cuts got priced in again. So, like, you have to be careful how you analyze this data. I want to make it clear to the people watching that whether we're having price cuts or rate cuts this year is kind of like watching a stock move. One day it's red, one day it's green. This stuff is changing every single day. And what we're trying to do is pay attention to what's going on, because there is a really weird gap right now between expectations of what the Federal Reserve is going to do and expectations based on what the bond market thinks. Look at this particular chart right here, okay? On the right side, you have these little dots. I'm going to highlight them in green. This right here in green at the top, over 5%, 5.1% is where the Fed thinks we're going to end up having Fed policy rates for the end of the year, right? That's where they think we're going to be at the end of the year. Well, look at where they think we're going to be next year. I'll highlight it in pink right here, right there, at about 4.6%. Fantastic. Well, what is the market pricing in for a terminal rate that is the highest rate we're going to get to? Well, the market is pricing in that we're going to be somewhere around, by the end of the year, 3.94% by the end of the year. Well, that's very different. That's actually substantially lower than both of the dots provided by the Fed. Well, why is that? Well, it's because the bond market is trying to price in this idea that, crap, we're probably going to go into a recession. Now, at the same time as we're probably going to go into a recession, and even Jerome Powell's indicator suggests we're going into recession, the reality is Jerome Powell basically has to be dishonest to us. This is what this guy was saying. The guy was saying Janet Yellen crashed the market yesterday because she was honest. Look at this. And I remember this yesterday because I was pitching the coupon code for the programs of Building Your Wealth link down below, where you get lifetime access to everything from learning how to be a millionaire in real estate, going from zero to millionaire. You don't even need anything to get started. You got stocks and psychology of money. You've got the Elite Hustlers group, learning about liability and insurances and building businesses, and custom live streams in that group. All of that for which we're changing the pricing for likely after this live stream here. But anyway, take a look at this. This chart, when Janet Yellen was talking, is basically what crashed the market because, like this guy says, she was honest. So look at where we are here. Here, we had that classic W shape of Jerome Powell. This is what happens. The market goes up when the press conference comes out, the statement comes out, rather. So the data comes out, the statement comes out. The market actually rises, so it goes up. After it goes up, it comes down a little bit. Then it comes up going into the presser. Then it goes down, and then it tends to close up. We tend to have a W shape. Unfortunately, Janet Yellen came out and said the truth that no, we're not backstopping banks, and markets cratered after that. I mean, the last 15 minutes of the day yesterday were a complete disaster while Janet Yellen was testifying. And so the individual we just saw in the interview, he's like, look, Janet Yellen said the truth. What's the truth? Well, the truth is simple, and the truth hurts, but it's very simple. No backstop of all deposits. That's what Janet Yellen said. And this is the first time we've really had this split screen event where you have Janet Yellen talking at the same time as Powell. And they didn't have a phone call first to discuss being on the same page, because Powell comes out and says, your deposits are safe. And then he's asked about it. Are you sure? And he says, all I'm going to say is your deposits are safe. We have the tools. Janet Yellen's like, nah, we're not going to extend FDIC. And so what did this former guy from the Bank of England say? Dude, in that case, go to Bank of America. Like, basically get out of the small banks and go to the big banks. It totally makes sense, especially if you have more than the FDIC limit, right? Of course. But that's what we've been talking about for quite a while now. That's just the way the game is played. And so that created some stress in markets yesterday. But I actually agree with the individual that we are likely to see inflation plummet. Every leading indicator I look at, leading indicator, not this lagging crap of these reports, but I'm talking company earnings, companies' forecasts for hiring, what sentiment is on the ground, what business owners are doing in regards to hiring, the availability of labor, not the stupid JOLTS data survey that says, oh, there are all these job openings. Bull crap, man. Talk to people. How many remote job opportunities are there? They're dwindling. How many opportunities are there for getting jobs at tech companies? Very few. How much competition is there for tech jobs? Massive. How many applications did Cloudflare get last year for 1,300 job openings? 400,000. There is a glut of labor supply. That's why you're seeing so much extra driver availability at Lyft and Uber, the likes of which we haven't seen before. And it's leading to a reduction in earnings for companies like Uber, because you have no more peak pricing because there's no peak. So it's kind of remarkable, the availability of labor supply that you're seeing. And that's deflationary, as is obviously autonomy and automation and other leading factors we're seeing. By the way, and this is just sort of a side rant, What the hell, Airbnb? You want to rent an Airbnb for like $250 a night because it's like, oh, the hotel's $250 a night, the Airbnb's $250 a night. Then when you get to checkout, it's like the $250 turns into like $600. It's insane. Oh my God, the amount of extra fees that are added on now are just absolutely ludicrous. I feel like rather than paying for like a room tidy up, I'm literally paying for house cleaners to do a deep cleaning of the entire house. It's insane. But anyway, back to this, what this individual says. He's totally right to say, look, we're probably walking right into a recession. And the fact of the matter is, I think the easiest thing you could do is look at Jerome Powell's response to a question like this one. I think this was a good question. Watch this response right here from Jay Powell. And he totally dodges the guy when the guy's like, are you just basically giving us another false sense of hopium? Listen in here.
That's just something that will have to come through softening demand and perhaps some softening in labor market conditions. We don't see that yet. And that's of course, 56% of the index. So the story is pretty much the same. I will say that the inflation data that we got, to your point, really pointed to stronger inflation.
If I could follow up on that, I was curious why you don't see more coming from the credit crunch, because it seems to me that's something that you'd actually welcome to a degree and expect. And are you not seeing more coming from that because you don't know, or because you just don't want to have another round of wishful thinking?
So
it's kind of interesting here. Another round of wishful thinking. So in other words, sort of making this argument of here, hey, like Jay Powell, why don't you think this credit crunch is going to hurt us more? Do you really think you can make an excuse that's going to say, oh, our market's not going to crash because you think inflation is slightly still trending up? And now we're going to have this wishful thinking that we could continue to hike and damage this economy and push us into a deep recession because you had an inflation report that showed 0.04% or 0.4% month over month inflation. Come on, Jay Powell, like you're losing the plot. The credit tightening that we're going to see could be as painful as a 1.5% rate hike, at least according to TS Lombard. They think that could be anywhere between 0.75 to 1.5%. That means we're knocking on the door of 6% interest rates here. That's insane. Of course, Jay Powell's response.
It's really just a question of not knowing at this point. There's a great deal of literature on the connection between tighter credit conditions, economic activity, hiring, and inflation. Very large body of literature. The question is, how significant will this credit tightening be, and how sustained will it be? That's the issue. And we don't really see it yet. It's so people are making estimates, people are publishing estimates, and it's very kind of rule of thumb guesswork almost at this point. But we think it's potentially quite real. And that argues for, being alert as we go forward, as we think about further rate hikes. For us, we'll be paying attention to the actual.
All right, we'll be paying attention, blah, 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 blah. Okay, so you kind of get it. It's basically like, yeah, we don't know. We don't know. Okay, but we already know that. So now here's another thing that a couple things that are interesting. So I want to address this one comment here about lower wage workers seeing wage hikes. And there's this comment here about cleaners. But first I want to respond to this person. So this person's name looks like Gag. It's either two boobs and a 4 in between, or his name's Gag, or her name. I don't know who this is. But anyway, this person says, friends don't make you pay for information. A friend shares information that could change your life. Kevin is not your friend. He could share this info on YouTube freely. His videos are an advertisement. Wow. So let's break this down. First of all, how many YouTube videos are on my channel? And how many hours of content are freely shared on my channel? The answer is thousands and tens of thousands. That is thousands of videos and tens of thousands of hours of content are available on the channel. So that's A lot of information is shared freely on YouTube. The next issue that you didn't address is the fact that people are willing to pay for information that isn't available on YouTube or readily available on YouTube. Let me make that clear. The reason I have courses is twofold. Number one, it organizes information in a row for you, so that way you can actually understand it and build your information together. Like if you watch a a real estate 101 video and then you go to a real estate 110 video, well, now you've lost context, right? And that's kind of what YouTube is. It serves you up really basic and then really complicated. You don't even know what you don't know when it comes to investing in real estate. And so the beautiful thing, in my opinion, about courses is this organized structure for actually learning a download of how somebody views the world and gets perspective in order and in a way that actually teaches rather than in a way that gives you information that potentially is more scattered, right? I mean, many of you know, I'm a big fan of wedge deals in real estate. Many of you know a lot of my principles, but that doesn't mean they've been taught in a way that's organized that you could adapt as easily as you could in a course. Now, sure, can we make videos on that? Yeah. But that's what the course is. The course is 40. A lot of the courses are like 40 hours in a row of that kind of content. I can't make a 40-hour long YouTube video. I can make 41-hour videos, but again, the way the algo serves it to you isn't that good. That's A. And then B, wow, how dare a YouTube content creator try to make money? You know, I really think this idea that people, it's evil for people to make money is really stupid. I don't know what's gotten into people's heads in America lately, but there's been this vilification of capitalism. It's really disappointing and saddening because capitalism is disinflationary. The fact that you could learn how to be a millionaire in real estate for $400 through a course rather than going to college for 4 years or you know, and spending 40 grand is insane. And they don't even teach you that stuff in college. So the capitalism is so wonderful, and we should really be proponents of capitalism and people making money. There are ways to have win-win products and services, right? I think people have this inherent aversion for some reason of, oh, well, I won't click that person's link because they might make money. Why is that bad? When somebody makes money, they're motivated to continue providing you a good or service and making it even better. So I don't know what this weird aversion to capitalism is. It's like people who are like, oh, I don't like your real estate startup because you're going to make housing unaffordable. And I'm like, what are you smoking? What makes housing unaffordable? The lack of rental supply for renters. What is my startup going to do? Take houses that are uninhabitable, like hoarding houses or fixer-uppers, and bring them to the market, and then potentially add casitas. So you're going from 0 homes on market to 1 to 2 to 3 homes on market per property. Like this vilification of capitalism and investors is so backwards and contorted. I don't know what's being taught in schools, if it's just a lack of being taught in schools. I think there's a lack of logic that's being taught in schools, and it's sad. It's really sad. And look, I'm not saying that, J-Pow has all the answers or he doesn't have all the answers. He just told you himself he doesn't have all the answers. I'm not saying I have all the answers, but the critical thinking that's missing in the world today is very sad. But going back to this hotel comment, because I actually think this is a very reasonable comment. So Tom Baker here says, I'm in the hotel business and it's next to impossible to hire cleaners paying $18 per hour. Rates for rooms are going up. So this is actually is something that I think is very important to talk about when it comes to the topic of inflation. And I think it's useful to look at it, on screen here. So what I would say is if you go in and basically say that the typical wage you would pay for a manual laborer is $14, let's say, and maybe now you have to pay $18. That is absolutely inflationary to you. That makes your costs of business go up. Now, that makes you desire to raise your room rates, but your room rates, your $250 per night hotel room, is not predicated on what your costs are. That's not how capitalism works. Your room rates are predicated on demand. So if demand for your rooms go down, you have to lower the price, and that means you eat the difference in costs. That then creates a lower margin business, and it basically pushes inefficient businesses out of the market. Now, just because Walmart and McDonald's are raising wages does not mean we have a wage price spiral. After all, the average wage in America is $32. Well, if the average wage in America is $32, even if you see lower wages go up and you have more of those, you're actually potentially dragging average wages down, especially if you're losing higher paid wages, right? So that's another aspect to consider when it comes to inflation. What's the best way to ask for a wage? I would say wait right now. I mean, we have a lot of strategies for that in the Elite Hustlers group, but this is probably the worst time to ask for a wage because it's such an uncertain time. I think one of the best things to do right now is make sure you are invaluable to your boss. Now, I get this all the time. People are like, oh, but does my boss see the value I'm providing? I guarantee it, your immediate supervisor, whoever that is, whether that's the owner of the company, your supervisor, whatever, sees and knows which workers work the hardest. They know who's sitting on their phone all day long and who is actually grinding all day long. And those people who grind will always end up getting rewarded. I'm highly confident of that. Our media and schools are corrupted. Probably. I start my new career and job on Monday. Congratulations. But yeah. Anyway, so these are interesting things to keep in mind. And I think it's very interesting about what this Bank of England individual said regarding Jerome Powell. I think he's right. You know, I think he's absolutely right that Jerome Powell is leading us into this tightening cycle that's going to push us into an ugly recession, sadly. And it's very unfortunate. Hopefully that recession is very shallow, because if the recession is not shallow, all stocks are going to get reamed. If the recession is shallow, then I could play music for you and basically hope that pricing power stocks continue to do very well, and we move on. You know, that's the goal. So anyway, check out those links down below for life insurance by going to metkevin.com/life, metkevin.com/free for 12 free stocks from Webull. Yeah, there you have it. Now I've run out of things to say while my music is playing. I'm hoping to get to the end of that music because I think it's kind of cool. Anyway, okay. I just figured out how to add that to the soundboard, so I think it's kind of cool. Okay, let's go listen in over here for a moment.
Collecting all this data to begin with. It would stop the profiling. It would protect our kids online, our innocent children, those under age 17. It would stop the listening on devices of private conversations. We know that is going to be our strongest defense against TikTok, new technological tools or weapons that China may try to get for strategic gain, but also ultimately to protect us both from a national security and a personal security perspective.
What do you think, what kind of concessions do you think either TikTok or even the Chinese government are willing to make on this? How far would they go? And then in terms of enforcement, how do we know whether they're even complying with what they say that they're going to do?
Well, we need transparency. We need truth. There is not the trust right now because, as I've said, they've lied to us over and over. And we do not have confidence that there's not.
Boring. Let's try Bloomberg.
CEO of TikTok is looking to defend the company on Capitol Hill a little bit later today, saying in prepared remarks the following: TikTok has never shared or received a request to share US user data with the Chinese government, nor would TikTok honor such a request if one were ever made. So he's going to sit in front of these senators. So he's going to say exactly that.
See, you don't actually have to. China will just take the data, and your statement doesn't answer that.
The representatives of the House, is that going to convince them?
Well,
No.
It can't convince them because the empirical data would highlight that the Chinese Communist Party doesn't exactly we're not going to honor your request very well. So that wouldn't necessarily go over in the same kind of way as perhaps they would wish. This is really the question that I have. To what extent is the questioning going to entirely rest on national security and how to ring fence the data? And how much is it going to really focus on some of the other, perhaps, side effects of social media? And the reason why I think that's important is because how much does it really target other social media companies as well versus just isolate TikTok from a national security perspective?
We'll come back to this story in just a moment. If you are just tuning in, about 18 minutes ago, the Bank of England hiked interest rates by 25 basis points, a 25 basis point rate hike after the ECB went 50 last week and the Fed went 25 just yesterday. Just run you through the price action briefly. The equity market futures still doing okay at 0.4% on the S&P 500. Sterling was rallying off the back of the decision. And in the bond market at the moment, your 2-year yield is higher by 3 basis points to about 396. Still get some economic data, Lisa, in about 12 minutes' time. We've barely talked about it. And I do think the news conference yesterday has changed the way we will receive that incoming information and that economic data for the Federal Reserve, because the Federal Reserve has basically told you that what dictated the outlook to some extent wasn't just inflation, it was financial stability.
So when does the data start to matter again? The economic data I'm talking about. And this is something that we've been talking about for a while, that we got hotter than expected inflation numbers for a while. So that at what point do you come in and say, okay, now we are looking at that again, and now we are looking at the potential for resurgence in inflation?
Let's get to Anne-Marie. She's over in Washington, D.C., our chief Washington correspondent. AMH, this Thursday, today, in front of the U.S. House Energy and Commerce Committee hearing, the CEO of TikTok will speak. What can he say today to allay some of these concerns?
But one thing that he's really going to want to highlight is this idea of this plan they have called Project Texas. It was a way to try to ring fence, isolate U.S. user data in the United States, use Oracle for this. But when you have reporting like I have last week that the U.S. government is telling ByteDance, you need to divest, sell these shares, or face a ban, clearly Project Texas.
Boring. Don't care about Project Texas.
Distressed.
Oh, stupid. Fine. We'll talk about something else. There's plenty to talk about. All right. So let's see here. We could talk about Coinbase. I guess we may as well knock out Coinbase because there's a lot of drama around Coinbase right now. And I suppose we may as well pull up some of the fundies for Coinbase. Let's go ahead and do that. All right. Coinbase, investor relations. What questions do y'all have about Coinbase? Oh, God. Coinbase. Good Lord. So I will tell you my sincere opinions about Coinbase. Let me get their latest investor relations page as well, and we'll just do it live together. By the way, I think I'm like a weirdo. Well, I think we all know that. But I love the SEC filings. It sounds so lame. Like every time I get a foreign issuer, I'm like, ew, what is this? Give me my SEC formatting. Yeah. But otherwise, yeah. Okay. So, let me see here what questions y'all have. Somebody writes at the same time, SEC sucks. Oh, God. Nerd. Uh-huh. Yeah. Did the CEO really just sell? Hold on. Let me see if I can get insider shares trades up. That actually would be very interesting. That would be very interesting if you did. Can somebody give me a source on that? I will. I do want to include that in my conversation on them. And I've got their latest 10K up. So we'll go through that as well. And yeah, balance sheet. And I want to look at cash. Okay, I'm on their cash flow statement. So perfect. But let me see. Kathy sold? No. Are you serious? Dude, she's been adding like crazy. CEO sold and Kathy did too. Really? Okay. We'll find out both of those. It's in his public filing. Well, yeah, I imagine. I guess that's a good way. Let me pull up Kathy. ARK. Would it be an ARK? K? Or, well, I guess I could just look at. Let's see. No, she bought Coinbase on the 24th. I don't see that she sold. Let me see here. Trading desk. Where did you see that she sold? Oh, did I stop getting email alerts? That's interesting. You haven't gotten an email alert from her in like a month. Maybe it went to spam. ARK F. Really? Okay, here we go. On Tuesday, according to reports, Kathy's ARK sold. Wow, really? All right. ARK F. Coinbase, Kathy Wood, ARK F. Let's look at this really quick, and then I want to see the insider transaction. Oh, yeah. 13 mil sold. Got it. Thank you for that. And then let me get the insider transactions as well, because that's quite interesting. News, filings, SEC filings. Let's see what we got here. Statement of beneficial ownership. Well, here's the 22nd. Let's see what we got here. So many of them. So here's the chief legal officer. They sold shares. Oh, fantastic. Yeah, everyone's selling shares. Great. I don't own any Coinbase, but I want to talk about it. So the chief legal officer sold shares. Then on the 21st, we have, yep, Brian Armstrong acquired. So he got some options, 28,000 options. He basically dumped all of them same day. Wow. That's quite interesting. That's very interesting. Okay. All right. And then, yeah, let's look at how big Coinbase actually is for Kathy, because just because they sold doesn't necessarily mean that it's a, you know, it was a meaningful amount. I mean, sometimes they just rebalance, right? They seem to do that pretty regularly. So Coinbase is their top 3 holding right now in ARK. Combined ARK funds, it's the second largest holding. Wow. All right. All right, let's do a little bit of this commentary here. Oh my God, here's a spammer now. Let's fix that. Oh yeah, not a scam at all. Double XRP. How do people fall for this? Ay, ay, ay. All right. Let's get into this. All right. Oh, you know what we could do? We should do it like this. You ready for this? I'm going to freak some people out when I do this. I think it's going to be great. Here we go. Hey everyone, Meet Kevin here. Coinbase has just been warned by the SEC of potential securities charges via a Wells notice, which was named after a dude in the 70s whose last name was Wells, and he thought it'd be the right thing to give people a heads up that they were about to get charged by the SEC, so that way they'd have a chance to provide some more information to the SEC to basically maybe not get charged by the SEC, and they thought that was a nice thing to do. Now, it's very interesting that this happens right after apparently Kathy Wood sold about $13 million in shares of Coinbase. I don't know how much that terribly matters, though, given that they have a massive $837 million position in Coinbase. That's actually a little scary for ARK here, although I don't think ARK is really heavily worried about crypto regulation not coming. I think it's a matter of if not, or it's a matter of when, not if, you're going to end up getting approvals for things like crypto ETF. But right now, the regulatory waters around crypto are pretty hot. And unfortunately for ARK, Coinbase sits at a 6.35% holding out of all combined funds for ARK Invest, sitting at a basically an average position of around $45 for the 3 different fund positions they have for Coinbase. They have a market value of nearly $1 billion, $837 million in Coinbase. So the idea that Kathy's selling $13 million of Coinbase is really a signal or anything, I think is relatively weak. But I will tell you, there is a bigger signal of something that I don't like seeing as much, and that's when executives start dumping shares that they just got assigned. And unfortunately, those sort of shenanigans have just started happening. Take a look at this. This picture here is a filing from the that was published on the 21st for transactions that occurred on the 17th and 20th. And it shows Brian Armstrong right here, the Brian Armstrong Living Trust, who's the CEO of the company, being assigned 28,000 shares and then immediately selling those shares. So he acquired the shares as an option for $0 basically, and then immediately sold all of those shares. Yikes, for market prices sitting around somewhere around $76 a share. Well, that works out to about $2.1 million of shares dumped by the CEO. But it wasn't just the CEO just days before the report of this Wells notice from the SEC. Certainly not insider trading at all. Would never want to allege that because no executive ever does that. But anyway, what do we have here? Oh, look, the chief legal officer. Oh, wow. The chief legal officer also dumped about 2,000 shares. Now, he still owns a whole lot more, owns somewhere around 62,000 shares left, which is, pretty sizable position there. Somewhere around, what is that, 3 times 2, somewhere around $6 to $7 million bucks in shares, but just did a little dumpy doodle there. In this case, Brian Armstrong's Living Trust just basically fully liquidated those shares for what they were received. So a nice little pump up there of the Brian Armstrong Living Trust. But it makes you curious, what could the implications of this warn notice be to the SEC or from the SEC, and what are the fundamentals of Coinbase? Well, let's look at some of this. So first, here's the piece that sort of breaks down some of what's going on here. The SEC issued a warning to Coinbase via the Wells notice. The stock is trading down in pre-market. It dropped in post-market yesterday. Right now, shares are actually down about 14% in pre-market. You can see that right here. 14% decline down to $66. So the executives literally just yeeted out right before this notice was made public, which it's likely they heard about the notice before the public did anyway. So it seems a little sus. But what does this warn notice actually do? Well, the warn notice, based on discussions with staff, the company believes these potential enforcement actions would relate to aspects of the company's spot market staking services, Coinbase Earn, Coinbase Prime, and Coinbase Wallet. Potential civil action may seek injunctive relief, disgorgement, and civil penalties. All right, so in English, the SEC ain't happy with Coinbase's business. They might take any profits away that the company made. They might shut down parts of the Coinbase business through regulatory requirements immediately, and they could fine Coinbase civilly. Now, obviously, a lot of this is coming after the collapse of FTX, Celsius, Voyager, Three Arrows Capital. Nobody knew that these would end up being as big of a fraud. I mean, these are like as big of a Bernie Madoff here as basically has happened since 2008. I don't think anybody even knew these were a fraud. But now it comes out that Sam Bankman-Fried basically defrauded everyone. And what do we got over here? Well, we jump in over here, and the SEC is basically making everyone really nervous. What is Brian Armstrong, CEO at Coinbase, now saying? Well, he tweeted a little bit of a story yesterday. He tweeted the following, conveniently after having sold his shares. Let's go ahead and put it in reader view. Today, Coinbase received a Wells notice from the SEC focused on staking and asset listings. A Wells notice typically precedes an enforcement action. 2 years ago, the SEC reviewed our business in detail and approved Coinbase to go public. Now, it's very important to remember that the SEC doesn't actually approve listings. That's very important to know. The SEC will review your filings and they'll add commentary to your filings, but the SEC actually leaves it incumbent upon the individual investor to evaluate whether a business is a fraud, whether a business is financially viable. And that's assuming you can even get financials for a business, right? Coinbase is publicly listed. So in theory, Coinbase could be a publicly listed fraud. It's unlikely, but nobody knows. But the point is, just because a company is a public company doesn't make them Gucci. It doesn't make them less likely to go bankrupt. Look at Voyager Digital, which was a public company in Canada. Bankrupt. Regulation didn't help at all over there. So Brian Armstrong here says that our S1, which is your original listing, clearly explained our asset listing process and about how much due diligence we take on crypto coins and that. Hey, look, there's so much of an unregulated environment in the space right now. There's a reason I've always kept any of my exposure to crypto to a very small and speculative amount. I've also very, very clearly been extremely concerned about stable coins. But anyway, what do we have here? While we understand that this is all part of our journey to reforming our financial system, we are right on the law, confident in the facts, and welcome the opportunity for Coinbase to get before court. Basically, the CEO is saying, look, we think we can win in court. We think crypto is good, and we think we're Gucci. That's fine, but convincing the SEC of that is going to be very difficult, specifically because the SEC has a way of being able to basically come after people where they won't regulate something. And then after the fact, they'll say, well, now after the fact, we think something's actually a security and we're going to find somebody for it. Now, that might make more sense of crypto tokens. Look what just happened yesterday with Tron and the SEC. So just yesterday, the SEC sued multiple influencers and celebrities for their involvement in promoting Tron. Look at this. Tron's network native TRX token dropped 13% after the SEC announces charges against Justin Tron and 3 of his companies, including BitTorrent and the Tron Foundation. Market cap of Tron sits at about 5.4 billion. It's insane. Look at that little tank there after the SEC charges. Anyway, the SEC is charging the Tron network founder with offering and for the offering and sale of unregistered crypto asset securities. Now, a lot of people would counter this and argue, dude, how could you legally list a crypto asset anyway? You don't let us. So in fairness, you have this whole crypto community that's like, come on, SEC, like tell us, is it legal or is it not? But your silence lets it happen. And then you start punishing people after the fact. That leads to a lot of frustration, right? Now, the other argument is that the SEC is hamstrung by bureaucratic processes and regulations that don't let them create a clear listing process for crypto assets. Who knows? But the definition for is crypto a security or not is really unclear right now. And that makes really all of the crypto space very, very risky to certainly massive volatility like what we're seeing with the stock price of Coinbase this morning. But anyway, they're also alleging that the Tron founder is fraudulently manipulating the secondary market with extensive wash trading. That's very interesting. Yeah, some folks here in the commentary are saying it's basically like entrapment. I mean, it's kind of not untrue, right? I mean, it's like if you don't tell us it's wrong and then you let people trade or sell crypto assets and then you say, oh, it's an unregistered crypto asset, but you didn't allow people to ever register it or tell people not to do it, then isn't that kind of entrapping? I mean, it's kind of like a cop standing on a beach and you drinking wine on the beach, and there are no signs saying it's illegal. And there are no laws saying it's illegal, but there are also no laws saying it is legal to drink on that particular beach. And then all of a sudden the cop decides, you know what, now I'm pissed that they're drinking on the beach. I'm going to arrest somebody for it. It's kind of like, but there's no law saying, well, you can't drink wine on the beach. And the SEC is like, well, there's no law saying you can drink wine on the beach. And it's like, what the hell? That is a little odd. So I think that's a good point regarding the entrapment. Now, somebody here is arguing that Brian Armstrong sells every month. That's like the most classic defense that people give executives for dumping stock is that, oh, this is normal. I've just happened to set up whatever it's called, the 10b5-1 plans or whatever. I just happened to set up a plan that'll conveniently dump millions of dollars of stock every single month. And don't worry, because it's all pre-planned, it certainly has nothing to do with information about regulation is coming. So it's kind of incredible. I like this person who says, you have to mute Kevin because he tries his hardest to understand crypto, but got burned last year and just fuds it. What's really remarkable is I think the depth of information that I provide on a lot of either stable coins or Tornado Cash or how cryptography works. Really, I think we're on like totally different levels of competence. I think that, I hate to say it, but I think that first of all, there are 4 levels of competence here. Okay. The 4 levels are very simple, but they're very important to know. One is unconscious incompetence. And this is usually your loud commentary people. Then there are people who consciously are aware that they don't know. Consciously know they don't know everything. I put myself here because the more I learn about crypto, the more I realize there's more to learn. And I think it's fantastic. I think it's really great. Then there are people who know that they know, right? This is like your professional level here. And then there are people who are what's known as unconsciously, there we go, competent. Anyway, most of the loud screamers on the internet who are like, you're just for the fun, are like children who actually think they know how to do a lick of research, and all they can do is scream FUD as if FUD equals fake news. There's a really big difference between fear, uncertainty, and doubt, which is actually usually a very reasonable thing to cover, and fake news, right? It is reasonable to argue that if there are issues with counterparty risk, they should be talked about, and that's not fudding, right? There are reasons to argue that algorithmic trading in Bitcoin could create fluctuations in the Bitcoin price based solely on the money supply. That's not FUD. That is coming up with ideas about why there's certain movement in crypto. And I think that belongs well in the camp of reasonably asking questions as somebody who knows they're trying to learn more and share perspective, right? This idea that everything that doesn't say that, oh, crypto's going to the moon is somehow FUD is absolutely ludicrous. The idea that, oh, the CEO is allowed to sell millions of dollars of stock a month because he does it every month is ludicrous. It like, when did that start? Oh, conveniently at the top of the market, and all of a sudden as we're riding down, all of a sudden you're continuously selling. You know, you have to be careful with the amount of moonshot commentary there is on the internet. Everybody just wants things to go to the moon, and don't get me wrong, I love when things go to the moon as well. But this idea that you can't share a negative perspective is remarkable to me. But okay, so let's look at the actual numbers here for. Yeah, and then I guess I should also argue that I didn't have any crypto assets to lose. I lost some money investing in BlockFi, the actual broker, unfortunately, because I thought investing in the actual brokerages was a good idea. That obviously ended up being an L. But I sold every single crypto-related asset I had in like coins or whatever in January of 2022, and I'm very happy I did that, along with all my stocks and all of my real estate. I sold everything. Now, I didn't buy back in at a perfect time. We have to be fair about that, to mention that as well. But that doesn't mean it didn't have the right idea at first. It just shows the challenges of being perfect with your market timing, right? You could get one side right, but then you could be less perfect on the second side. And that's the tough thing about timing. But let's look at Coinbase's cash flow statement for the year ended 2022. So a lot of people are asking me about, like, hey, how is this regulation actually going to affect Coinbase? And I think it's really important to look at their financials and see, okay, well, how is Coinbase going to be affected? So I think the way we have to look at this is we have to look at Coinbase, and we have to look at their net income here, their net income or loss, $2.6 billion. It's absolutely insane. Of that, they paid out $1.5 billion in stock-based comp. I mean, the company is throwing money out of the window on stock-based compensation to people like the CEO who are dumping their shares. That's a problem. That's a problem. But anyway, so net cash in operating, negative $1.56 billion. Their free cash flow is vastly negative. I mean, you're sitting at somewhere around negative just over $1.6 billion in negative free cash flow. How much cash does this company actually have that's not deposits, right? So we have to get rid of custodial funds right here. So you have to look at, okay, we've got 4, and then you've got some USDC, amounts of loan receivables. It's a little complicated when you look at bank-like institutions, but let's go with 4.425 billion in cash here. And then let's look at not deposit liabilities, but let's actually subtract out payables and accrued expenses. You've probably got about 400 mil here, some borrowings. I mean, you've got a lot of cash. You've got about $4 billion of free cash at least at Coinbase, which is very good, $4 billion of free cash. Now, it's a little problematic, though, because you did lose $1.6 billion of cash in 2022. So you really have a run rate of like maybe a little over 2 years here. So if these negative revenues continue at Coinbase for the next couple of years, you're going to have to raise a lot of capital and you're going to have to destroy a lot of shareholder wealth because this negative cash flow is not going to be able to last. Now, what's really insane here, folks, this is absolutely insane. Look at this. Their net revenue over halved, more than halved. And while their net revenue more than halved, their operating expense for technology and development doubled, nearly doubled. So more than half on revenue and a near doubling of tech. And look at this. This is like a more than 50% increase in SG&A. That's insane. Well, specifically general and administration going up about $700 million. Technology and development going up about $1 billion. So you've got about $1.7 billion of more expenses with revenue that is actually $4.2 billion lower. So seriously, minus 4.2 bill in rev and plus 1.7 bill in expenses. Why would you touch Coinbase with a 10-foot pole? You know, and then they have I would call it a less than 2-year run rate. So you've got a business that has a less than 2-year run rate. Its expenses are exploding while its revenue is declining. And on top of that, you've got the insane regulatory risk. Why would you touch it? That doesn't make any sense to touch this right now. It's no surprise to me that the executives are doing this with their shares. Milk the cow while you can, man, but it's going away. This is scary. And I mean, how much fundy analysis did we just do on this? Like 5 minutes, okay? It's already a disgusting hot potato. Do I really think if I do more, that opinion is going to get any better? No, of course not. You know, I mean, you could click around though. Okay, yeah, the Bitcoin log price scale. Let's clickbait everybody with the log scale of Bitcoin. It's going to the moon. Don't worry. And the reality is Coinbase will do very well if Bitcoin goes to the moon. I promise that. Coinbase will do fantastic if Bitcoin goes to $1 million, which is a projection of some people that it'll go to $1 million, $2 million. It's not my projection, but I think it's very, very, very interesting. So that's my take on Coinbase. All right, let's move on from Coinbase. Okay, what the hell is all this commentary here about Square? Square initial commentary. Hindenburg targeting Square. Ooh, that's a big one. Hindenburg. Block shares sink 20% after Hindenburg discloses short position. Oh God. Dude, imagine imagine running a firm like Hindenburg where you could take a fat ass short. You could load up on puts, man, every week down the ladder and just milk profits after you do these reports. Oh my gosh, it's really, really incredible. Anyway, so Hindenburg Research. Let's see what we have here. The humanity. All right. So we know they did Adani last. They can't even get their formatting right on their website. Look at that. Come on, man. Dude, even I know how to code HTML to where the strong brackets actually go into the header. Good Lord. Oh, geez. All right. Let's go through it. Stand by for the Hindenburg short report investigation. The balance sheet is very robust. Oh, Lord. So entertaining. I don't know. I love finance drama. You know, people tell me, like, oh, finance drama is so childish. And yeah, it is, but it's really entertaining. I mean, I prefer it over like Kardashian drama. I can't stand that stuff. But everybody's different, whatever floats your boat. No offense, whatever you want, pick your poison. I happen to like finance drama. I think it's fun. And I will vigorously defend my positions. And that's why actually sometimes I like looking at some of the commentary because I can respond to it, especially when we do it live. What balance sheet? That's a good one. All right. Let's do this live together. Let's go. So here we go. This is probably going to take a hot minute. All right, ready? Let's start the intro music. Well, ARK Invest just bought some more Square block stock, and now all of a sudden Hindenburg has disclosed a short position on the $44 billion or once $44 billion company Square. And I say that because in the pre-market, well, let's just say Square is not very happy. It's actually dragging Coinbase down even more as well. Coinbase was down 11% in pre-market. Now it's down about 15%. But forget about Coinbase. Hindenburg Research has disclosed a big fat short position on Square. Square was down 6% yesterday. Makes you wonder who knew the Hindenburg report was coming. Now Square stock is down 19.5% after Hindenburg Research discloses their short position. This comes after their last mega short on the Adani network, which was a massive short investigating the fraud or potential fraud of shell companies being used to massively profit off of Adani stock in India. Hindenburg Research was also the company that exposed Nikola for the fraud that it was, rolling their truck down a hill. And implying the truck was actually powered by a hydrogen power engine, which was all a fraud. Now, Square is apparently being accused of, quote, fraud facilitation. And Hindenburg is suggesting that Square stock could fall as much as 65 to 75% based on the findings in their research. Well, folks, make sure you get yourself life insurance because we need to buckle up and get into this research into Hindenburg. And you can get that life insurance by going to metkevin.com/life. If you sign up, I make a little bit and you get awesome life insurance. You can Apple Pay and Android Pay for it. Make your life simple and put it on auto pay. It's what Lauren and I use to pay for our life insurance. So check them out by going to metkevin.com/life. All right, Block, formerly known as Square, is a $44 billion market cap company that claims to have developed frictionless and magical finance technology with a mission to empower the unbanked and underbanked. Our 2-year investigation into Block has concluded that Block has systematically taken advantage of demographics it claims to be helping. The magic behind Block's business is not innovation, but rather the company's willingness to facilitate fraud against customers and the government. To avoid regulation and dress up predatory loans and fees as revolutionary technology and mislead investors with inflated statistics. Our research involves dozens of interviews with former employees. You have to be careful with interviews unless they can provide evidence. So we'll take a look at that, as well as litigation records and FOIA requests. Most analysts are excited about the post-pandemic surge of Block's Cash App. That's true. During the stimmy days, man, Square was exploding. Our research indicates, however, that Block has wildly overstated its genuine user counts and has understated customer acquisition costs. Former employees estimate that 40 to 75% of the accounts they reviewed were fake, involved in fraud, or were additional accounts tied to single individuals. Yeah, but that's not necessarily wrong. I mean, if Square comes out and says, hey, we opened 1 million new accounts, and half of those are people making a savings account and a stock account, I mean, that is accurate, right? That's incumbent upon the investor to realize the same person can have multiple accounts. That's not necessarily fraud. So I want to see where this fraud is. Core to the issue is that Block has embraced one traditionally very underbanked population, criminals. Oh, okay, let's see. When users are caught engaging in fraud, they didn't ban a user. They showed how blacklisted accounts were regularly associated with dozens or hundreds of active accounts suspected of fraud. A phenomenon of allowing blacklisted users was so common that rappers bragged about it in hip-hop songs. Okay. Jack Dorsey has publicly touted how Cash App is mentioned in hundreds of hip-hop songs as evidence of its mainstream appeal. I paid them hitters through Cash App. Block paid to promote the video for a song called Cash App, which describes paying contract killers through the app. I mean, some of this is probably, designed to be hyperbole. Would be interesting to see if there's actual evidence of this. And I'm sure I'm sure every bank to some extent has criminal activity that goes on. I mean, I'm sure people get Zelled for crimes all the time. Here's the drug money. Zell dinner, $5,000. Anyway, let's see here. To test this, we turned our accounts into Donald Trump and Elon Musk, and we're easily able to send and receive money. Yeah, I mean, I don't know why that's necessarily bad. I mean, is there something wrong with that? I mean, maybe. I suppose if there's a KYC rule, like a know your customer rule that requires you not have a fake name, but I mean, I suppose anybody can make like a MetaMask wallet and transact, but then again, that seems to be more of the DeFi space, right? So, okay, interesting. And those are some thoughts that would be running through my head. Former employees described how Cash App suppressed internal controls and ignored user pleas for help as criminal activity ran rampant on the platform. I mean, it is also true that companies like tech companies don't really have the incentive to argue or to start banning and closing a bunch of fraudulent accounts or potentially fraudulent accounts, because it does hurt the user metrics, right? I mean, you saw the same thing with Twitter with the bot army. Well, wait, Twitter happened to be founded by Jack Dorsey, who's now running Square. Wait a minute. Is it possible that fake accounts propping up user metrics at Twitter are also happening at Jack Dorsey's other company, Square? Yeah, that's interesting. COVID pandemic, existential threat to merchant services in the environment. Amid Cash App's anti-compliance free-for-all, the app facilitated a massive wave of government COVID relief programs. I mean, that is true. No bank account needed. That's true. They let people deposit your money straight into this so people could spend it right away. Massachusetts sought to claw back over 69,000 unemployment payments from Cash App just 4 months into the pandemic, suspecting transactions at Cash App's partner banks were disappropriate. Okay, well, this is actually interesting because if you could make a fake account and then start claiming potentially stimmy checks or unemployment through Cash App, that creates a really big problem. That's very interesting. That is a fair point. The data shows how it compared to its Ohio competitor, Cash App's partner bank had nearly 10x the number of applicants who applied for benefits. Yeah, so this goes back to COVID fraud. I believe that there was a lot of COVID fraud at basically every level. I definitely believe that. As Block stock soared on the back of its facilitation of fraud, Jack Dorsey collectively sold over $1 billion of stock over the pandemic. Yikes. And other executives also dumped millions. All right. Okay, so Congress passed laws that legally capped interchange fees, but Block avoided these by routing payments through smaller banks. I mean, frankly, that doesn't sound like fraud. That sounds actually smart. I mean, to some extent, like and I get it. I think there's a legal gray loophole there that they're jumping through, but Square isn't a bank. You know, JP Morgan has a limit on the fees they can assess you, but like smaller banks don't because they face less regulation. That's why we're having a banking crisis right now, right? And so if you could take the money that people deposit with you and spread it out to multiple different small banks, and now it enables you to charge more fees, I mean, that's probably part of the game. I don't know that that's necessarily fraud. It's probably wrong, like that's not the intent. But I mean, even SoFi, who has its own banking license, is like, we now offer $2 million of FDIC coverage. How are you doing that? Oh, well, we're going to a bunch of small banks. Exactly. So, I mean, that's just sort of the game that gets played. That doesn't seem so terrible. I'm looking for like the smoking gun here, because usually there's something like really crazy. But so far, this doesn't seem very surprising to me. And this is, I won't reiterate how I hate financial stocks in a recession. But anyway, competitor PayPal has disclosed it's under investigation over its use of small banks to avoid interchange fees. Yeah, but that doesn't mean it's wrong just because you're under investigation. I mean, maybe a law will be passed that changes that, right? Block's $29 billion deal to acquire Afterpay closed in January. Let's see here. Afterpay has been celebrated as a major financial innovation. I mean, no, I think it's just a great way to charge people massive interest, allowing users to buy things like a pair of shoes or t-shirts and pay over time, incurring massive fees if subsequent late payments are made. The big problem with buy now, pay later right now is, the big problem with it. This is true. Well, yeah. Somebody's saying, remember, their argument is whether to short them, not whether it's legal or not. I don't think you could say them taking advantage of a legal loophole is a reason for shorting, right? I don't think you can argue that. Like taking advantage of a legal loophole, like you would expect businesses do everything they can to maximize their profits. That's why legal loopholes often exist, because they lobby to have those legal loopholes. It's all a broken, rigged system. Don't get me wrong. I'm not defending the system. I think how complicated things are complicated on purpose to make the rich richer, and I think it's disgusting. But let me say one thing for sure. You should never use buy now, pay later, in my opinion. And I've said that ironically, but honestly, I have said that since 2021 when I first started covering a firm. I'm like, let everybody else use that, but you should not use it and run from it in a recession. I've said that since day one, and I still believe it. Like, you should not use these services. They are very, very expensive. Afterpay was designed as a way to avoid reasonable lending rules, such as basically lending without credit checks or charging higher APRs. Yeah, but again, that's not illegal. Like, the fear about buy now, pay later regulation has been in existence for the past 2 or 3 years. We already knew that. There's nothing wrong with that. Afterpay delinquencies are skyrocketing. No shit. Going into a recession, they have no collateral. You think a firm is going to show up at your house and take the sneakers off your feet because you bought them with buy now, pay later, and now you're not repaying? No. What are they going to do? They're going to kick you off the platform. That's it. That's the most they can do. That's not a surprise. Block regularly hypes mundane predatory sources of revenue as technological breakthroughs, such as 31% of Cash App's revenue comes from instant deposit, which Block says it pioneered. Every other major competitor we checked provides a similar service. Dude, it's marketing, man. Who cares? Like, that's not fraud. There's nothing wrong with that. I don't know, man. Hindenburg, this one's pretty weak so far. On a purely fundamental basis, even before factoring in the findings of our investigation, we see a downside of 65 to 75% in the shares. Maybe you do. Block is valued like a profitable growth company. Okay, so now we're going to talk about valuation. I'll talk valuation. I'll go through the valuation myself in a moment. I'll go through the valuation. Nobody gives a crap about price to book for a tech company, dude. Come on, man. And selling for a forward adjusted earnings multiple of 41. We'll look into that in just a moment. We'll look at your multiples. Block is also facing threats from competitors like Zelle, Venmo, PayPal. No shit. None of this is news, man. We think Block misled investors on its key metrics. Look, having fake accounts, that's the biggest thing you got. So show me more about, and the CEO selling shares. Well, you could say the same thing about Elon Musk. Elon Musk dumped $24 billion on normies, myself included, last year, okay? So what? Jack Dorsey built up a $5 billion fortune. Good for him, man. That's not fraud. That's the game. That's what stocks are, man. So where is the fraud? And then we're going to go through the fundamentals. So a few things. So let's go through their evidence. Rapid adoption will lead to exponential growth. Fantastic. Where's the evidence of fake accounts? That's what I want to see. Block has a fundamental downside. Oh, I'll go through that myself in a moment. They have criminals on their platform. Dude, every bank has criminals. Criminals are everywhere. Everybody's a criminal to some extent, I imagine. Everybody breaks the law at some point. And in theory, if you've ever rolled a stop sign in your life, you too have broken the law. And after all, what is a criminal? Well, a criminal is somebody who breaks the law. Therefore, are you not also a criminal? So then it's just there are varying degrees of criminals. Signs are hard to miss. There is even a gang named after Cash App with members arrested for fentanyl distribution. Okay. like whatever. I paid them hitters through Cash App. Okay, like this is a fantastic PR for Cash App. This is interesting. I want to see the fraudulent account stuff. And look, I want to be clear here. I don't own Square. I don't care if the stock goes to zero. I really don't care. I'm just trying to look at this as a reasonable person. All right. Cash App has claimed to have 80 million annual transacting active users, a highly inflated number given evidence of massive user duplication. Okay. Cash App, page 7 of the SEC filing, they say the company has 80 million annual transacting actives. Okay, well, you have to see what an active is, because if you're just going to say an active, like an active could reasonably be an account, right? So that's from their annual report. I'll go look at that in just a second. Let's see here. Cash App's users, many users have dozens or even hundreds of accounts. Well, I want to see these screenshots. Hold on. Let me go to because they didn't convert to a PDF. So let's go here. Cash App gang, who cares? What do we have here? Cash App as a sponsor, big deal. Of course, they're a sponsor. Okay, here are the user metrics growth. Actives. Well, you have to look at what the definition of an active is. And if the definition of an active is just active account instead of active people, then it's not necessarily wrong, you know? Okay, let's see here. Some fancy graphs. What is this? Okay. Yes, so what? A bunch of people, like, I don't know that there's necessarily something wrong with having a bunch of different Cash App accounts. I mean, there are a lot of Elon Musks, but you can name yourself whatever you want. That doesn't necessarily mean they're fake. I mean, I can name myself, you know, BJ69 or you know, 69 for BJ or whatever on the app if I wanted to. I mean, does it have to be your real name? I don't know. And look at what is this? Credit card sent to Hindenburg, whose real name is not Donald Trump. Well, I mean, that's interesting. I wonder, but then again, I'm pretty sure you could put almost any name you want on your credit card. Like Danny Duncan showed me his credit card, and on his credit card from American Express, his platinum card says Danny fucking Duncan. And I'm like, that's pretty badass. They didn't stop you from putting that name on it. And he's like, no, they didn't care what name I put on it. And part of that reason is because you could put, you know, whatever business name or in theory you want. So I wonder if that's just more of a broad business issue or banking issue than it is something that's specifically related to, you know, what's it called? Jeez, Lord, Square. But anyway, what do we have over here? Here's a quote for details about a Consumer Financial Protection Bureau petition. What is this? Slow walking the disclosure to investors about the existence of the investigation. I mean, really? Like somebody is supposed to get like urgently respond to a lawsuit from the CFPB? Of course, everybody's going to take that easy. The longer you drag it out, usually A, you want to be detailed with your response, and B, like, you got to run a business. Like, your top priority isn't responding to complaints. That's just part of business, though. Who's this? Proceeded to request a physical card, entering her name and the last 4 of her social, okay? Rather than requiring all 9 digits of her social, Cash App ran the incomplete investigation through a third-party ID check company to determine whether the information belonged to a unique individual. Why skip a basic legal requirement? I mean, that's fair, you know, if it should be the full, but how do we know that you have to see? Look at this identity verification. See, to me, that's more of a question of ideology then. Like, look at it this way. If you're Square and you're like, all right, the government requires us to check the IDs of people before we issue something. And you're like, well, the government allows us to use a third-party service to do that. Well, then it's incumbent upon the third-party service to do a good job. Let me give you an example. If you want to approve you're an accredited investor and you prove that to investready.com, like if you want to invest in House Hack, and they give you a letter saying you're an accredited investor and you defrauded them or they didn't ask you for all the right information, it's not my problem anymore because I'm relying on InvestReady as a third party to verify that you're an accredited investor. You know, that's a problem with InvestReady. They're promising me that you're credit, right? So like businesses do that. They use third parties. I don't know, man. Okay, so they didn't require, okay, now they require, Block recently began requiring full socials. Well, looks to me like they're trying to fix the problem. I don't know, man. I like, to me, this seems crazy. I'm working to weed out the 40 to 50% of fraudulent activity accounts I'm working with daily. I mean, also, it's not uncommon for former employees to shit on the company they worked for. I don't know, man. This is not as much of a smoking gun as I thought it would be. You know, Hindenburg, I don't know that they really had as much as they thought they had here. This is their 2-year investigation. Let me go to the investor relations page. Investor relations, Square. Let's look at the fundamentals because maybe they have a point about the fundamentals of Square being overvalued. Maybe they have a point there. And I don't invest in Square and I don't short Square. So I really don't care. But let's look at their annual report anyway. And let's see if Square really is overvalued or, you know, a fraud or whatever. I mean, to me, this, I don't know, man. It's just not so crazy. But you know what is crazy? And we're going to pull up this report here and I'll go through it with you. But what is crazy is Square is actually recovering here in the pre-market. People are buying the dip on Square right now. It's only down 15.8%. Coinbase, on the other hand, is down 17.18% in pre-market here. Keep in mind, if you want to use this awesome app, I am paid to tell you, you can get 12 free stocks by going to mettkevin.com/Webull. Mettkevin.com/Webull, you get 12 totally free stocks, which could pay for your life insurance you can get in as little as 5 minutes. All right, so let's look at this. This is their last annual report. Let's just do the same thing we did earlier with Coinbase. Let's go to their cash flow statement first. And maybe it's overvalued, but it's not a crime to be overvalued, right? Okay, so they lost a lot of money. They lost $553 million in 2022, while at the same time they managed to pay out to their employees $1 billion of stock-based compensation. Good Lord. Like, I'm not opposed to stock-based compensation at all. But, like, at least make money, right? Somebody here says, I ran a fake name for the longest time until they sent me a new card last year with my real name on it. That sounds like they're trying to get better. It sounds good to me. All right, so what do we have here? Net cash provided in operating activity. Oh, that's good. So we actually made some money from operations, but that could be deposits. That could be an increase in deposits. So I'm not sure if that's actually going to be free cash. That is one of the issues with looking at bank-style companies. So then you have payments to redeem convertibles, proceeds from, it looks like they paid off some of their, what's it called? Some of their PPP money. They paid some of that off, paid off about $480 million of PPP money. You know, in 2020, I think people got mad at people for taking PPP money. I remember that with, what was that burger joint? There was something with an S. There was some burger joint. Everybody got mad at it. It's like nobody knew what we were going to experience in 2020. You know, what kind of hell we were going to walk into. But anyway, net cash provided by financing activities. Okay, so we got some money from financing over here. Okay, let's look at their actual numbers here. So we're losing money. Yeah, I mean, so you can't really do a multiple evaluation on them because they are losing money, right? So the multiple is really infinite. That is fair. In fairness, that's a very expensive company. Now, they are still growing transaction-based revenue. Unlike Coinbase, they're still growing revs. So let's calculate this really quick. So if I go 5701 divided by 4793, Shake Shack, that was it. Thank you so much. That's 18.9% 18.9% growth. That's actually still decent in subscription or transaction-based revenue. 4552 divided by 2709. You're growing here by 68%. That's pretty good as well. Hardware up a little bit. Bitcoin revenue obviously fell. That makes sense. Transaction revenue costs are 2719, up 23%. At least that's better than Coinbase, where Coinbase had negative revenue and their transaction costs were like doubling. Like their revenue was half and their transaction costs were doubling. Like Coinbase is the real loser here. This short report should be on Coinbase. 861 divided by 483. That's a little 78%. That's also not that big of a separation from their revenue growth rate. So that's not terribly unusual. Their OPEX did explode though. OPEX up, and this is why their stock-based comp is skyrocketing. OPEX up 55%. Yeah, I don't know how they're going to go profitable again here. It's going to be a hot minute before they can go profitable again with this sort of OPEX growth. I mean, if they had this OPEX with the same growth as they used to have, well, they actually are at about the same level of revenue as they used to have. The problem really is their OPEX growth. So they have to grow faster than their OPEX growth. And they're growing their total net revenue is basically negative, slightly negative. If you look at just these two segments here, not considering Bitcoin, 5701 plus 4552 divided by about, what do we have here? 2868 plus 775. I mean, they still grew by somewhere around 36% on their transaction and subscription revenue. And that is actually where they do have margin. So they just need to grow faster than their OPEX. Yeah, is it expensive? Are they likely to grow faster than their OPEX? Probably not. Would I invest in them right now? No, I think they're probably a toxic bombshell because you don't even know how many losses are going to come out of the loans from Afterpay. But their financials are actually not as bad as some of the other fintech players. They're not good. I mean, again, I don't want to touch them. But let's see, what do we have in debt over here? So if we look at actual debt, customer payables, we'll go away from that. Let's look at settlements, accrued expenses. That's 1.5 billion. That's 2 billion right here. Current, that's 2.5 billion. Safeguard, that doesn't matter. Deferred tax liabilities, I'll throw it. Well, those are non-current, so those don't matter as much. So we're going to go with about 2.5 billions right here in roughly bills to pay. And they've got cash of 4.5 billion right here. That's not to include their short-term investments. That puts them at about 5.5 billion free cash, not considering customer funds, receivables, loans available for sale. Those could become worth a whole lot less because they're probably dangerous. This goodwill is insane. The fact that they put $12 billion for their brand on their balance sheet, that's nutty. Wait, what the hell? Look at their goodwill. Holy crap. Now, see, that's where you could hit them with like, how do you say that? Look at their goodwill. They went from their brand being worth 500 million to their brand being worth $12 billion. I mean, see, that looks insane to me. That looks kooky dookie. But I mean, they've got cash. They've got so much cash that they could burn these negative cash flow. I mean, they actually have positive cash flow. They're not running out of cash. They're not going bankrupt. Yeah, their EPS might be negative for a while, but they have the capacity to keep burning cash because they're paying most of the people in the stock. Yeah, that's dilutive to shareholders. Does it really look like they're a massive fraud because they got some fake accounts and fake names? Not really. I think this is somewhat of a weak report by Square, but that's my first take on it. I mean, maybe it's worth going even deeper into it, but my first take is not that great. I actually think it's more justifiable that Coinbase is falling, and that's actually exactly what's happening. This sucker's down like 20%. Anyway, that's my take over on Coinbase. Oh, you've been watching the interview with Ben Mallah? That's awesome. Yeah, that was a fun one. I enjoyed that one too. Thank you. All right. So that is our thought on Coinbase. All right. So, yeah. that I think now it's time to go make some coffee and then head over to the course member live stream. So I think that's some pretty good insight. Let me quickly, though, look at what we're doing with yields, treasuries. Treasury yields kind of flat, 3.48. You know what's crazy, though, about yields right now is that mortgage rates aren't actually really falling. So Duquan reportedly arrested in Montenegro. Why do I not believe that? Let's see here. I don't see where you're seeing that. I know they've been trying to get him. Terra Luna guy. Yeah, we do the bell with course members now. Oh, yeah, they got to do the closeout music. You're right. But, yeah, we now do the opening bell with course members. So if you want lifetime access, check that out. I haven't changed the prices yet. I got to get this live stream done. So if you want to join and get lifetime access to all of the content in there, pretty awesome. You get lifetime access, and I keep adding stuff. We do fundamental analysis every day in there, too. A lot of Q&A. It's pretty fun. So look forward to seeing you there. I got to get some more coffee now, and I hope you enjoyed the longer stream. Goodbye.